Very good morning. So, which was the last section which we did yesterday? 35D was given to you as homework to study. Besides that, section 37, subsection 1, page number 133. Section 37, subsection 1 was discussed yesterday, but some part of it was given to you as homework to go through. Do you recollect? So till now, how many sections we have done? Definition of business, section 2, clause 13. Definition of profession, section 2, clause 36. Method of accounting, section 145. Don't talk. See, when I am repeating the sections, you should also try to recollect. This is the only way in which you will remember the sections. The only way to remember the section is to refer it 8 to 10 times, 10 to 15 times. So as a faculty, it is my habit to intentionally use the section numbers very frequently, so that more number of times you listen to those section numbers, there are more chances that you will remember the sections. So when I revise some sections, you should try to recollect that this section were covered. So this chapter, first of all, we had the definition of business, section 2, clause 13. Then we had definition of profession, section 2, clause 36. Correct? Then we moved on to section 145, method of accounting. Section 145 says that income under the head PGBP will be computed based on the method of accounting followed by SEC, either mercantile system or cash system. And yesterday we also moved on to section 28, charging section. Section 29 is procedural section. It is just saying that if you want to compute the income as referred to in section 28, then you have to refer section 30 to section 43D. Then we moved on to the first category of sections, that is sections relating to expenses. In that too, we discussed only the first part, that is sections relating to allowing the deduction for expenses. First one being section 30, expense relating to building. Second one is section 31, expense relating to plant, machinery, furniture. Then we have section 32, depreciation. Then we also discussed the section 37, subsection 1, which is a general deduction. I think this many sections we have covered up. Besides, we also referred to section 32 AD. I told you that it is already expired in the last year. But one of the condition of section 32 AD is, if you have acquired the asset and you have claimed deduction under section 32 AD, then you cannot transfer the asset within 5 years from the year of acquisition. If you do that, whatever amount of deduction was allowed to you will be added to your income and tax will be levied. That is the reason that section is still in the notes, otherwise it is expired. So you can't claim any deduction in 32 AD as of now. I think this many sections we have covered up. So today, first of all, we will once again refer to general deduction, section 37. Some part was given to us homework to refer it. Section 37, subsection 1, if you recollect, I had simplified the section for you by putting it into some conditions. The first condition was, your expenditure should not be covered by section 30 to 36. Section 37, subsection 1 is a general deduction. If your expenditure is the expenditure for which you want to claim deduction, if it is already covered by section 30 to 36, then you can claim deduction in the respective section. You can't go to section 37, subsection 1, because specific rule will always prevail over the general rule. So the first condition to get into section 37, subsection 1 is, your expenditure should not be covered by section 32-36. Second condition is it should be a business expenditure, or maybe you can say it should be a revenue expenditure. It should not be a capital expenditure. If it is a capital expenditure, you go and capitalize and claim depreciation in section 32. Third point was it should be a business expenditure. It should be incurred exclusively for the purpose of business or profession. If it is incurred for personal purpose, you can't claim any deduction. Then we move on to fourth condition. Actually, fourth condition is part of explanation 1 to section 37 subsection 1. We say that only legal expenditure can be claimed as deduction. Illegal expenditure cannot be claimed as deduction. This is the simple version of first explanation to section 37 subsection 1. But if you refer to the explanation, it doesn't say that legal expenditure or illegal expenditure. It says that any expenditure incurred by the associate which is an offense will be deemed to have been incurred for purpose other than business. So that will not be allowed as deduction. But I have simplified this for you, saying that legal expenditure deduction is allowed, illegal expenditure deduction is not allowed. And the fifth point, last one, was CSR expenses cannot be claimed as deduction. That is explanation 2 to section 37 subsection 1. So this thing we have covered. Here we are having examples saying that this expenditure will be allowed as deduction. Actually, in the past years, this expenditure were claimed as deduction by different SSEs while computing their income. They were claimed as deduction in section 37 subsection 1, but in some cases income tax officers did not allow the deduction by giving some reason, saying that because of this we are not allowing the deduction. But looking at all those controversies, CBDT had come out with an instruction saying that following list of expenditure will be allowed as deduction. So we have the list of expenditure. This is given by the CBDT, saying that income tax officers should not argue with the assessing, following expenditure should be given as deduction. Number 1 is Diwali and Muhurat expenses. So you might have observed that Indian people are more spiritual as compared to other countries. Throughout the world, the only most spiritual country, if you want to select one out of 180-85 countries, that would be India. So we believe in God. We have the system of doing puja, etc., etc., etc. Every religion has a different mechanism, but we tend to display all those things. So if you might have observed during Diwali, see, in India we have people belonging to different caste, religion, etc. Every religion, every caste have their own New Year. January to December is a New Year which is followed by Christians. So basically it was Britisher left India and they kept the calendar of January to December. Therefore we are following since years. But for every person belonging to every different caste, religion, etc., they have their own different New Years. So specifically, all those Gujaratis and Marwadis, they would celebrate their New Year during Diwali. I think 2 days, just 2 days after Diwali. So they have a tendency to get their do the puja, etc., for their books of accounts. So small business organizations, on the day of Diwali, they will do Lakshmi Puja, etc., in the offices, and those expenditure were debited to profit and loss account and they were claimed as deduction. Income tax officer said that no, this cannot be claimed as deduction. This Lakshmi Puja and all those things you are doing for your own satisfaction. It is for your own satisfaction, not for your business. So this expenditure is no way connected to your business. That is what the income tax officer said, and to a certain extent he was correct also. But CBDT came out with an instruction saying that don't play with the emotions of the people. The amount of expenditure is too small, so don't argue. We are Indians and they have the tendency to remember God before starting anything. So allow them the deduction for the expense. So CBDT said that Diwali and Muhurat expenses will be allowed as deduction. So now no officer is going to argue. Then we have point number 2, deposit under Tatkal telephone deposit scheme. In olden days, we used to have only one there were very less number of telecom service providers. In fact, there was no mobile in this country. I am talking about that era. So if you want a landline connection, you have to make an application to MTNL, BSNL. You have to make an application, you have to pay them deposit. Definitely that is a refundable deposit. But once you make an application, you will get the connection maybe after 4 years, sometimes after 6 years, 7 years, 8 years. So getting a telephone connection was a very big challenge in those days. And I still remember, if someone has got the new telephone connection, there would be a celebration in the house. Or someone has bought, say for example, that Bajaj Chetak scooter, if you recollect. Along with the scooter, you have one additional compartment, 1 BHK flat type of thing. So if those scooters, if you want to buy from Bajaj, you have to do a booking. Once you do the booking, the scooter will be delivered to after 2.5, 3 years. And you have to make an advance payment. That was a system. Your parents might be aware about that. Your generation has not seen those difficulties. Besides cooking gas connection, nowadays also cooking gas connection is a very big deal for a lot of poor people. But in those olden days, most of them were using the kerosene kind of stove. So cooking gas connection also, not the pipeline connection, forget about that, it was not in existence. That cylinder connection, if you get the cylinder connection, then also you are lucky enough. So these three things, it was very difficult to get in those days. So when you get a telephone connection, you have to give deposit, which is a refundable deposit. Ideally, deposit should appear in the asset side of balance sheet, saying that it is refundable. So when I have given, if I can cancel the connection, I am going to get my money back. So ideally, this deposit should appear on the balance sheet asset side. But CBDT has given the instruction saying that this deposit is allowed as deduction. So the year in which you have got the connection, you have given the deposit for that. That will be allowed as deduction. And subsequently in future, if you disconnect the landline connection, you will get your deposit back. In that year, it will be taxable. So in the year of giving deposit, deduction will be allowed. In the year of getting back the deposit, that would be taxable. Payment for telephone or telex connection. Expenditure incurred for replacement of fluorescent tubes. See, earlier the tube lights were of, I think, 40 volts. Now the tube lights, the LED tube lights are around 18 volts. Only 18 volts. So the power consumption is down by at least 50%. Old bulbs, if you remember that yellow color bulbs, they would consume a lot of power and they would also generate heat, lot of heat. Thereafter came the CFL tubes and now it is LED bulbs. So day by day, because of new technology, the power consumption is less. In one of the showroom, the showroom owner changed. See, if you go to the showroom of clothes, sari showroom, in Chennai we have in T Nagar we have a very big showroom, Potties. What is the name? So I think it is a showroom of ground floor plus 2 floors. So in that showroom, sari will be displayed, So in the showcase there will be a tube light. So if you count, there will be more than 200 tube lights. If he decides to replace all those 200 tube lights, the cost would be anywhere into lakhs of rupees. So one of the SSC had a showroom and he replaced all the tube lights and he incurred some amount of expenditure, maybe into lakhs. Income tax officer said that no, this is not allowed, this cannot be claimed as deduction, it is not a revenue expenditure, it is a capital expenditure. So CBDT said no, it is not a capital expenditure, it is a revenue expenditure. when you install wiring etc. for the first time, along with that if you install the tube light, then it should be considered as a capital expenditure. Thereafter it should always be considered as a revenue expenditure. So expenditure on replacement of fluorescent tubes would be considered as a revenue expenditure. Premium paid on loss of profit policy. Do you understand loss of profit policy? In fire insurance, there are two types of policy: loss of stock and loss of profit. Laga contribution is membership of a trade association. If you are a trader, there might be traders association. You become a member of that association and you have to pay membership fees. That membership fees will also be allowed as deduction. Annual listing fees. If you want to get your shares registered, listed on stock exchange, then you have to pay annual listing fees to the stock exchange. That can also be claimed as deduction. Expenditure on training of apprentice. See, when you join any company as a trainee, you don't know anything. So company is going to incur a lot of cost on you for providing you the training. Some officers were of the opinion that this cost is not an expenditure relating to business. If you provide training to that new employee, he may run away. So not related to business. But there was some argument. So CBDT came up with an instruction then saying that whatever expenditures incurred on providing training to apprentice, to the new trainees, that would be considered as a revenue expenditure. Deduction will be allowed. Civil defense expenses means security expenses. Security expenses that can also be claimed as deduction. Professional tax. See, we have not done the chapter of income from salary, but just I would like to give you a reference saying that in the chapter of income from house property, you get deduction for municipal tax. Similarly, in the chapter of income from salary, when we start, you will realize that you get a deduction for profession tax. Profession tax is a tax which is levied by the state government, not by the central government. And profession tax is levied because every person, not only professional, but every person who has got the employment in the state has to pay profession tax. Persons who are doing job as well as the people who are self-employed, everyone has to pay the profession tax because you have got an employment opportunity in the state. See, if you are employed, say for example, you complete your chartered accountancy and you are employed by some company, then you are getting a salary of say 50,000 per month. That amount you are not earning only because of your capability or your skill. Because the state government has taken a lot of efforts to ensure that there is huge amount of economic activities here, there is very high growth in this city. That is the reason you have got an opportunity. After becoming chartered accountant, if you feel that your skills are so, you are more skilled person and you can easily earn 50,000-60,000 rupees, go to some small states like Manipur, Meghalaya, Sikkim, etc. You will realize that no one will be ready to pay more than 25,000 rupees. So why you get a salary of 50,000 a year in Chennai? Because over the period of years, state government has taken a lot of efforts to ensure that more economic activities would take place in this state or in this city. So they are taking huge amount of efforts to ensure that there is a employment generation. Therefore, they charge one tax called as profession tax. All those people who are doing job, their profession tax, their employer will deduct from their salary and pay to the government. Which government? State government. But those people who are self-employed, all people who are self-employed, they have to register themselves with the profession tax department of the state government and they have to pay profession tax directly to the state government. So all those doctor, lawyers, chartered accountant, etc., who are into their own practice, etc., they have to get the profession tax registration number and they have to pay profession tax. Their income is taxable under the head PGBP. Therefore, the deduction for profession tax is also available under the head PGBP in section 37 subsection 1. But if you are doing a job, every month you will receive salary, na? From your salary, your employer would deduct the profession tax and he would pay to the government on your behalf. So all those people who are doing job, their profession tax will be deducted from their salary by the employers, and it would be paid to the state government. But all those people who are self-employed, they have to register themselves and pay the profession tax on their own. So if your income is taxable under salary, then you claim deduction for profession tax under income from salary. Whereas if your income is taxable under the head PGBP, you claim deduction for profession tax under the head PGBP. Is that very clear? Last one is advertisement expenditure. You may feel that why there is a need to say that advertisement expenditure should be allowed as deduction. You may feel so. The reason is you might have heard something like heavy advertisements. In the CA Foundation, somewhere in the chapter of capital and revenue expenditure and receipts, it says business organization has incurred heavy advertisement. So you consider that as deferred revenue expenditure, saying that benefit will be derived for more number of years. So you spread the expenditure over a period of 2 to 3 years. Have you done that in your CA Foundation? So that was the useless thing to do. Because do you believe that if you incur heavy advertisement cost, people are going to remember your advertisement or your product for next 2-3 years? If I give advertisement in the, say for example, Times of India newspaper, on the front page, full page advertisement I give, say for example, it is costing 20 lakh rupees for 1 day, and I have given advertisement continuously for 10 days, so it costed me 2 crores. If I ask a certificate from Times of India saying that I have incurred heavy advertisement, continuously full page, front page ad for 10 days, so just give me a certificate saying that if I advertise my product in your newspaper for continuous 10 days, I am going to get a customer for next 2-3 years. He will say that go and get your mental checkup done. Moral of the story is there is nothing called as heavy advertisement. Advertisement is advertisement. So entire advertisement cost can be claimed as deduction at one go in the year in which the advertisement cost is incurred. In accountancy also there is nothing called as deferred revenue. That you will realize once the accounting standards would start. So either the expenditure is a revenue expenditure or it is a capital expenditure. There is nothing called as deferred revenue. So in accountancy, if someone has debited profit and loss account partially for the advertisement cost by spreading it over 2-3 years, then we are going to give deduction right away in the first year itself. Is that very clear? Why this pen is not working? Anyway, have you understood? So we'll proceed. Section 37 subsection 1. With this section 37 subsection 1 comes to an end. This taxes flow chart will refer at a later stage. Once we do section 40 clause A sub clause 2 and sub clause 2A, and once we do section 43B, we'll have once again come to section 37 to refer this. Have you all referred section 35D entirely? If yes, then we'll discuss today. If no, then we'll try to postpone it. Have you all referred? Have you gone through the videos which I had sent in the group yesterday? All the videos? Okay, do one thing. For the time being, so there are two big sections here in the chapter of PGBP now. Section 32 we have done. We have one more section, section 35 scientific research, and section 35 AD specified business. These things we will discuss. Pen is not working. It is not charged. Once again. Pen is also afraid of him. The moment he came, it started functioning. Anyway, shall we start? Okay. Okay, if you have referred to section 35AD properly. Yes, listen to me. If you all have referred to, how many of you have referred to section 35AD? Raise your hands. Only 5-6 people. So do one thing. I want you to refer to the section. I would skip section 35D as of now. I'll move on to section 35, scientific research. Please go through that, section 35AD. Okay. So we move on to section 35, scientific research. It is page number 117 in your textbook. Just keep that in front of you. You'll never have a chance to refer to that because we are going to have a lengthier discussion on that without referring to it. Listen to me carefully. Expenditure on scientific research. We got independence in the year 1947. Thereafter, I am just giving you the background of this section. Listen to me carefully. Don't talk between yourselves. Once we got independence, the biggest challenge which the government of India was facing was how we would be in a position to feed such a huge population. Because India did not have the sufficient quantum of food grains also that we can feed our people. So, if at all you are having your grandparents still, then you might have heard them saying that in our days, we even did not have the chance to have a food twice in a day. So, they are not bluffing, this is the fact. So, in those days, India did not have the sufficient amount of food grains also. So, the biggest challenge for government of India was to how to ensure that there is a huge large scale food grain production. Please don't talk. So government invested heavy amount of money for green revolution, and after the green revolution India became a food surplus nation. As of now India does not have any problem with respect to food. See why people in some parts of the country people may die because of hunger, and that is mismanagement. We are not having scarcity of food, but it is just because of mismanagement. See, yesterday itself the central government has announced that out of 135 crores. Now, last time when the lockdown was announced, the situation was in the control of the central government. Decisions were taken by the central government. After 3-4 months, now state governments were of the opinion that central government is controlling a lot of things. They are not giving us the liberty to decide. The local area we know well as compared to the central government, and central government then give the powers to the state government, then you manage on your own. And we are seeing what is the situation as of now. Lockdown was lifted area wise, and now the cases are going up like anything. So central government had given the powers to the state government, and now every state, most of the states, except barring 5-6 states, every state is suffering, having the shortage of oxygen. So, over a period of time, I told you that government invested money, heavy money for green revolution. After green revolution took place, India was a food surplus nation. So the focus came to the management. So as of now, if some part of the country, if people are not having food grains, then it is just because of mismanagement. There is nothing else. We have the adequate quantum of food grains to ensure that even if no agriculture activity takes place, for at least 6 to 7 months, we can feed the entire country. Yesterday itself, central government has announced that 5 kg of rice or wheat will be given to 80 crore population for the next 2 months. So it clearly shows that we have the adequate amount of food grains, but it is just because of mismanagement that some part of the country people are suffering due to malnutrition, or some part of the country people are dying because of hunger. It is unfortunate in a country like this, the country which is self-sufficient in respect of food, people are still dying in some part of the country because of hunger. But moral of the story is, after the green revolution took place, we are a food surplus nation, so there is no scarcity of food. But we were always dependent on other countries when it came to medicines. We see such a huge population, such a big country, if it depends on other countries for medicines. See, food, clothing and shelter, these three things are not the only basic necessity. Medicine is also a basic necessity. Nowadays, you realize that oxygen cylinders are also a basic necessity. So there are a lot of, over a period of time, education will also become a basic necessity. So, food, clothing and shelter is a basic necessity. It goes without saying. But besides food, clothing, shelter also, there are a lot of things which are basic necessity. So, India was a country having huge population and was dependent on other countries for medicines of small illness also. Like flu medicines also we were importing. So we are importing most of the medicines. And if a country having this much amount of high population, if it is dependent on others for medicines, then other countries may take the undue advantage of this situation. See, right now that remdesivir injection is being sold in the black market at 25,000, 15,000, 10,000. This is what is happening. People are taking undue advantage of the situation. Similarly, if you are a country dependent on other countries for medicines, then you can become a victim of the situation. Other countries who try to take your advantage. So government of India one fine day decided that we don't want to remain as an importer of medicines, we should become an exporter. So for changing the situation 360 degree, you have to take a lot of efforts. So government of India had meetings with a lot of big giant companies who were into the research aspect of it. Like they appoint the scientist and then the scientist will do the research in drug research, etc. The way we did the research for the vaccine, and we have come up with the vaccine in a short span of 8 to 9 months. So in those days, the government of India had meetings with big giant companies like, say, for example, Ranbaxy Laboratories, Dr. Reddy Laboratories, Cipla Industries, all these companies. They had a meeting with the government of India, and government of India asked them, why you are importing medicines? Because you are playing a role of just a small trader. You are just importing medicine and selling it in India, and thereby you are earning profits. But actually your real job is not to just import the medicine and sell it. Your job is to do research, come out with new drugs, test it. If they are successful, get it patented and go and sell in the international market. You earn good amount of profits in your business. India will also become self-sufficient when it comes to medicines. And the moment we have more exports, our trade deficit will come down, or foreign exchange reserve will not be exhausted in importing medicines. See, if we go on importing medicines and we go on spending our foreign exchange on only importing medicines, when we'll have an opportunity to import the capital goods? When we will grow? That is what government of India tried to explain to this different companies. But India is a conservative society. So the companies were hesitant to spend money on research because they felt that if we spend money on research and if the research outcome is not as per our expectation, then we will incur losses. So Indian companies were not ready to put heavy amount of money or investment in research. So government came out with an idea to help them out at the initial stage. And government came out with section 35 saying that if you incur expenditure on research, we are going to give you deduction. We'll give you deduction for revenue expenditure as well as the capital expenditure. And the moment government inserted one section for giving deduction of capital expenditure incurred on a research, slowly few companies started doing research. And over a period of just 1.5 years, companies like Ranbaxy Laboratories, they came out with some superior drugs, better quality drugs. See, in my days when I was a kid, if the dog bites you, then we used to take 14 injections. 14 injections. Nowadays, I think they are giving only 3 or 4 injections. So it has come down from 14 to 4 injections just because of research over a period of time. The point is, government incentivized doing the research, and because of this section, a lot of companies started incurring huge cost on research. And just within a span of 1.5 to 2 years, there were companies like Ranbaxy Laboratories who found out a premium or a better quality drug. They did the research, they tested it, everything was functioning fine. So those medicines were patented, patent was taken for it at an international level, and then they started exporting. Specifically, companies like Dr. Reddy Laboratories, Cipla Industries, and Ranbaxy Laboratories were the huge beneficiaries of this section. Around in a span of just 1.5 to 2 years, the share price of Ranbaxy Laboratories went up from 50 rupees to 1400 rupees, just in a span of 1.5 to 2 years, because they did the research and they came out with some advanced drugs wherein you can cure a particular illness with less number of doses or less amount of cost. So once this happened, they themselves realized the importance of research. So all the companies slowly started doing research. But India is a very big country. If the research happens at a very small scale, then we will not have that much advantage. So government decided that we should give more incentive for doing research, so that research should happen at a very large scale. Big companies, giant companies should set up their own research laboratories. They should appoint the scientists, they should pay them salaries, they should get the research done. So research should not happen on a very small scale, saying that Ranbaxy is doing research only on 2 medicines. Simultaneously, they should do research on 10 or 50 different medicines. So government came out with a concept of weighted deduction in section 35 over a period of time. Weighted deduction means if you incur 100 rupees, we'll give you deduction for 200 rupees. See, if government gives you deduction for capital expenditure, don't look into the books, look here. If government gives you deduction for capital expenditure, say for example, you have incurred a cost of 10 lakh rupees on research, and government allows you deduction for entire 10 lakh right away in the first year, what is the consequence? Your profit will fall down by 10 lakhs. And if you fall into a 30% slab income, if you are a company, you have to pay tax at 30%, then you will save tax to the tune of 30% of 10 lakhs. In other words, your tax savings would be 3 lakhs. Government started giving 200% deduction to big companies who are into large scale research. Meaning thereby, if you spend 10 lakhs on research, we are going to give you 20 lakhs as a deduction. If you give you 20 lakhs as deduction, your profit will fall down by 20 lakhs and you will have a tax savings of 6 lakh rupees. So you are actually spending how much? 10 lakhs and you are saving tax to the tune of 6 lakhs. So indirectly your investment in research is only 4 lakhs. Over a period of time, government realized that because of giving so much incentive, now all the big companies have actually started doing the research. But still small companies are not into research. See, research cannot be restricted to medicines. Every field, every product, there should be some research. Few years back, I'm not talking about just 15 years back, we had some product in the market called as e-diary. We had an electronic diary. In olden days, we used to keep the small booklet kind of diary in the pockets wherein we used to write the name and contact number of the people. And those diaries were having the alphabets to find out that particular name of a particular person. Thereafter came the e-diaries in the market wherein you had a small, very small, half the size of the today's mobile, small electronic diaries were there. You can store the name of the person and you can store the contact details of the person. So those small electronic diaries were there in the market. The moment the smartphones came, smartphones have replaced a lot of products from the market. Because of smartphone, that electronic diary has vanished from the market. Now it is not available. No one is manufacturing. Now you can store the name, email ID, address, everything in your smartphone itself in the address book. Besides, if you recollect, maybe when you were a kid, in your home you might have sometime you might have purchased a separate alarm. You set up an alarm, you get up in the morning. Now, very less number of shops are selling alarms because this facility is anyway available in the mobiles. So in next maybe 2, 3, 4 years time, this alarm will also get vanished from the market. It is just an outcome of research in this field over a period of time. So every field would require a research. If the research is done, the product will get upgraded, human life will be more simpler, things will be simpler for people. So over a period of time, government realized that research is not only required in the field of medicine, the research is required in all fields. So government started giving direction for research even to those people who are into the business of manufacturing goods. So government said that whatever goods you are manufacturing, do research on that product, come out with some better quality products having some extra features, etc. So earlier when the section started, it was specifically for those who were into the biotechnology business. Slowly, the benefit of the section was extended to those who are engaged in manufacturing business as well. And government came out with one more option saying that those small companies who are unable to set up their own research laboratories now, because they don't have that much amount of capital. Their capital itself is too small. They cannot spend money on setting up the laboratory, appointing the scientists and paying them salaries to get the research done. So government came out with an idea saying that these small companies also, they should also have a chance to do the research in their respective field. Therefore, instead of setting up a laboratory, instead of having funds, since they do not have the fund, they could not set up their own laboratories, but still they should also have a chance to do the research. So the government came out with one more option saying that instead of doing research on your own, you can outsource the research. You can outsource the research to those institutions who are dedicatedly doing the research job. For example, are you aware about in textile we have a separate cloth which is crease free, so you need not press the cloth. There are such quality of cloth which is crease free, means once you wash the clothes, now pressing will not be required. That kind of cloth they have done a research and they have found out. Now say for example, uh, there is no product in the market. I'll give you two examples, small examples. Nowadays, right now, whatever clothes we wear, if because of heat, if we are sweating, say for example, I'm wearing sky blue shirt. Because sweating, underarms, etc., backside also, the color of the cloth will change. Anyone can easily recognize that I'm sweating a lot. So in my mind, I'm having an idea that there should be some cloth. Even if I sweat a lot, the color of the cloth should not change. It should remain the same. There is no such cloth in the market as of now. Let us say, for example, some big company like Raymond comes up with the idea, saying that we want to do research and find out such a cloth wherein even if you sweat, then the color of the cloth will not change. It will remain the same. And don't you feel it is a better idea? People would be ready to buy those clothes. So similarly, there is some research. There are certain things wherein you have the product, and on that same product you are doing the research, so that the new product will have extra features, better quality, etc. And there are certain things, the product is not there in the market. Product is just there in your mind in the form of a imagination. Like say for example, I take lectures for CA intermediate. My observation over a period of time is that the CA intermediate students or a CA final student as well, when you teach anything to them, they will understand everything. But the problem is, they say that, sir, we don't remember these things. When this taught, we understand everything, but how to remember so much amount of information till the examination? So we go on saying that you have to revise. 3-4 revisions are required. You should refer the summary notes. All those guidance teachers would give. But in my mind, I'm having an idea saying that given a chance, I would set up my own research laboratory. I would appoint the scientist and I would ask them to do a research on a medicine wherein if you just have one tablet and then you start reading 50 pages, you can remember. Such kind of medicines are not available in the market now. This is right now just in my imagination. So, if at all, actually I start this research and if I incur the expenditure, please don't talk. Actually, if I incur the expenditure on research to find out such kind of medicine, then do I have the business? I am just doing the research. If the outcome of the research is positive, then the medicine will be developed and then it will be sold in the market and then I'll have the business. So right now the product is just in my imagination. So there are two types of research. Number one, you already have one product. On that product only you are doing the research to get the upgraded product with more features, better quality, etc. And second possibility is the product on which you are doing the research, you don't have any such product in the market. That product is lying just in your imagination. So in that case, you don't have any business. You are just doing the research. And if the research outcome is positive, then you will have a product. Then you will develop the product. You will launch the product, and you will start the business. So that research expenditure we divide in two parts: pre-commencement research expenditure and post-commencement research expenditure. What do you mean by pre-commencement research expenditure? Pre-commencement research expenditure means a research expenditure which is incurred before commencing business. Why the business is not commenced now? Because the product on which I am doing research, that product do not exist in the real life. It is just in my imagination. So I will incur the cost to do the research. That cost will be called as pre-commencement research expense. Is that very clear? And if the product on which I am doing the research, the product is already existing in the market, but I am doing research to ensure that the product gets upgraded, then in that case I will be having my business also, and simultaneously I will be doing research also. In that case, whatever expenditure I incur, that will be called as post commencement research expense. Have you understood this? So research expense can be divided into how many categories? Two categories: pre-commencement research expense or post-commencement research. Small companies who cannot do research on their own, because they have less amount of capital. Instead of doing research on their own, they can outsource their research. So, as I give you the example saying that if Raymond wants to come out with a cloth, which would be a sweat-free cloth, then Raymond doesn't want to do the research on their own. Then Raymond can go to Raymond can outsource the research. They can give money to some research association. For example, in Mumbai as well as in Ahmedabad. In Ahmedabad, we have a research institution called as Ahmedabad Textile Research Association. In Mumbai, we have Bombay Textile Research Association. So, say for example, Raymond gives an amount of 20 lakh to Bombay Textile Research Association, saying that spend this money to do the research. Right now, we have cotton. We have different variety of clothes now. We have cotton, we have terry cotton, we have silk. So we have different variety of clothes. So you do research, you do the permutation and combination of different clothes. You do research and you give us the combination or the proportion which will help us to create a cloth which will be a sweat-free cloth. So if Raymond is giving money to Bombay Textile Research Association, then we can say that Raymond has outsourced its own research. In that case also they can claim the deduction. So research can be done in two ways. Number one, SSC can do research on his own, or if the SSC is a small SSC, then he can outsource the research. If he is doing research on his own, then also there are two possibilities. The product on which he is doing research, that product is not in existence in the practical life. It is right now in his imagination only. Once he will do the research, and if the outcome of the research is positive, then there will be a product in the market, there will be actual product. So whatever expenditure is incurring can be called as a pre-commencement research expenses. Or the product is already there in the market and you are having intention to have an upgrade on that product, then whatever expenditure you are incurring, that can be called as post-commencement research expense, because the business is also going on and simultaneously research is also going on. So over a period of time, a lot of companies, a lot of SSCs have taken the advantage of this section. Now from 2014 onwards, government has realized that now people have realized the importance of research. Now we need not give them incentive. So from 2014 onwards, government has started reducing the deduction on research. There were situations wherein deduction in certain cases it was 200% of expenditure incurred, somewhere it was 175% of the expenditure incurred, somewhere it was 125% of the expenditure incurred. As of now, all this is reduced to 100%. So as of now, we don't have anything called as weighted deduction for scientific research in section 35. Now the deduction, maximum deduction is how much? 100%. So let's move on to this section. Page number 117. There is section 43 subsection 4. Section 43 subsection 4 gives you the definition of scientific research. What do you mean by scientific research? Scientific research means activity for the extension of knowledge in the field of natural or applied science, including agriculture, animal husbandry and fisheries. No one is going to ask you this definition. See this section 35, this section, I have given you notes twice. Number one in the form of a tabular presentation, and another in the form of a flow chart. So we'll first try to refer the notes from the flow chart on page number 121. Okay. Okay. So part 1 is what? Part 1 is what? SSC doing his own research. That is divided into how many parts? Pre-commencement research expense and post-commencement research expense. So left hand side we have pre-commencement research expenses. Pre-commencement research expenses means expenditure incurred on a research before commencing the business. Here the government says you should have some timeline. You can't say that I will be doing research for 10 years, 15 years. You cannot do this. You cannot go on doing the research. There should be some end to any activity. So government says you keep some timeline to do the research, and whatever product you have got, you launch that product. Once the product is launched, business is started, then simultaneously go on doing the research. So government has set a timeline saying that if you have incurred expenditure on research which is of the nature of pre-commencement research expenses, then those will be allowed as deduction only if that expenditure was incurred during 3 years prior to the date of commencement of business. In other words, if the SSC has started business in the current year on say 15th August 2020 and he was doing research from 15th August 15, so he is doing research since last how many years? 5 years, but he will get deduction only for last 3 years. So government says set the timelines, complete your research in a span of 3 years, otherwise you will be penalized. How will you be penalized? By not getting the deduction, will not give you deduction. So you incur the expenditure and you are not going to get any deduction for that. So government says pre-commencement research expenses, they are allowed as deduction provided they are incurred during 3 years immediately preceding the date of commencement of business. In other words, any expenditure incurred on a research prior to 3 years from the date of commencement of business, go backward for 3 years. If prior to those 3 years some research expenses incurred, then you can't claim any deduction. Now, this research expense can be divided into 2 parts: capital expenditure and revenue expenditure. Capital expenditure, see, first of all tell me whether the business is existing or not. No, SSC is just incurring money on cost on research. Therefore, government says revenue expenditure will be allowed as deduction in a restricted manner. Now, everything will not be allowed as deduction. Only exclusively cost which is incurred for research will be allowed as deduction. See, electricity charges, carriage inward, carriage outward, printing and stationery, postage and telegram, these are general expenses. These are not related to research. So government says, since your business do not exist as of now, we will give you deduction only and only for direct cost which is related to research. Therefore, in revenue expenditure, you can claim deduction for number 1, salary paid to research staff. For example, you are appointed scientist and you are paying salary to them, then that cost is directly related to research, that can be claimed as deduction. Number 2, if you have purchased some raw material for doing the research, that raw material cost can also be claimed as deduction, provided this research activity is approved by the prescribed authority. Besides that, so basically you can claim deduction for how many expenditure? 2 expenditure. Number 1, salary paid to the research personnel, and number 2, raw material purchase for research. Besides these 2 things, you can't claim deduction for any of the revenue expenditure. So general expenses like carriage inward, carriage outward, printing and stationery, postage and telegram, electricity expenses, etc. will not be allowed as deduction. Why so? Because your business do not exist. So this expenditure will be allowed, 100% deduction will be allowed for this expenditure. Perquisites and other expenses, deduction will not be allowed. Deduction will not be allowed. See, you may think that there is no business, I am just incurring the expenses on research. Even if you give me deduction, against what you will give deduction? I don't have any income only. So government says, even if you don't have income, you claim the deduction, thereby your income will turn out to be negative, and that negative amount will allow you to carry forward. And then when you start the business, you will have a positive income. You go and set off that negative amount against a positive income. Capital expenditure, incurred on a research can be fully claimed as reduction in the first year itself, except the cost of land, because land is non-depreciable asset. Forget about claiming deduction here. You are not going to get even the depreciation deduction because land is a non-depreciable asset. So if the capital expenditure is in the nature of buying the land, then the land cost cannot be claimed as deduction. Other capital expenditure like your purchase plant, machinery, furniture, etc. for the purpose of research. You have set up a research laboratory, in that there is a furniture. You also purchased a plant. You have constructed a building. All these things can be claimed as deduction. So building, plant, machinery, furniture cost related to research can be claimed as deduction. Entire cost will be allowed as deduction. Once you have claimed deduction for the entire cost, depreciation deduction is not allowed. Depreciation deduction is not allowed. Why so? Because if you claim depreciation also, that would tend to amount to double deduction. That would amount to double deduction. Therefore, government says capital expenditure incurred on research, entire cost can be claimed as deduction, but later on you can't claim deduction for depreciation. This left hand side flow chart, it is 100% copied on the right hand side also. Right hand side is what? Post commencement research expenses. Post commencement research expenses means your business is already started. Now we are doing the business at the same time, simultaneously you are also doing the research. Now the point is, since the business is already started, section 37 subsection 1, your general deduction section will be activated. So all the revenue expenditure, you can claim deduction in section 37 subsection 1, and the revenue expenditure which is exclusively for research, you can claim deduction in section 35. So revenue expenditure 100% reduction is allowed. Then pre-commencement part, pre-commencement part in revenue expenditure, what was allowed as section? Only two expenditure. Number one, salary and raw material. Now everything will be allowed because business is already commenced. Capital expenditure, cost of land not allowed as deduction. Other capital expenditure, entire cost is allowed as deduction. Depreciation deduction cannot be claimed. So can I say this is same as the pre-commencement part itself? The only change is in case of revenue expenditure, you can claim deduction for any of the expenses. Now this note, this note has lost its relevance. This year onwards, this note has lost its relevance. I told you saying that a company, I told you that government wanted to ensure that research happens at a very large scale, because India is a very big country. If you do research on a very small scale, 2-3 companies are doing research, that it will not have a very big impact. So we should have we should ensure that the research is done at a very large scale in India. Therefore, government came out with 200% deduction, which is called as a weighted deduction. That 200% deduction, it was then reduced to 150%. Now onwards, it is reduced to 100%. So what was it? That is what I am trying to explain you. In case of a in-house research, generally how much deduction is allowed? 100% deduction is allowed. However, in case of post-commencement research expenses, if following conditions are satisfied, then instead of 100%, now higher deduction is allowed. But that higher deduction is stopped from this year onwards. Previous year 2021, higher deduction is totally stopped. Meaning thereby you will get how much deduction? 100% deduction will be allowed. 200% was reduced to 150. Now 150 is reduced to 100 from this year onwards. Weighted deduction is discontinued with effect from previous year 2021. So what was the weighted deduction now? For getting a weighted deduction, certain conditions were required to be fulfilled. Number one, who can get the weighted deduction? Only company could get the weighted deduction, because only company will have huge amount of capital and only company can do research on a large scale. Company should be involved in the business of biotechnology or business of manufacture or production of any article or thing, except those products which are specified in 11th schedule. Means those products which are specified in 11th schedule, On that product, don't do research. Government says those are negative products, sin goods, like liquor for human consumption, tobacco, aerated water, soft drinks. So don't do research on that products. We are not going to give you any deduction for that. Research and development facility should be approved by the prescribed authority. Which authority is a prescribed authority? There is something called as Department of Scientific and Industrial Research. So government is having a department DSIR, Department of Scientific and Industrial Research. That officers of those DSIR unit would come to see the research laboratory to ensure that the research laboratory is set up in accordance with the guidelines issued by the government. So if your research laboratory is in accordance with the guidelines issued by the government, they would give you a certificate and then you will be eligible for a weighted deduction. But from this year onwards, weighted deduction is totally stopped. So what was the deduction earlier? Land, anyway, the cost of land was not allowed for section. Building. In case of building, weighted deduction was never allowed. How much deduction was allowed? 100% deduction was allowed, but 200%, 150% deduction was never allowed. Other revenue and capital expenditure. What do you mean other capital expenditure? Except land and building. So plant, machinery, furniture, etc. Earlier 200% deduction was allowed. Thereafter 200 was reduced to 150. Now with effect from previous year 2021, this 150 is reduced to 100. So now this section has become simpler for you, saying that you have to remember just 100% everywhere. Earlier we used to have different percentages in different sections. Now everywhere it is 100%. So this part, page number 121, talks about which research? Research which is done by the SSE himself. This is also called as in-house research. This is also called as in-house research. Means SSE might have set up the research laboratory and he might have appointed the scientist. He might be paying the salary for the scientist and he might be incurring a lot of costs related to research. That research cost is called as a in-house research cost. Then we also have something called as outsourced research. Small companies who could not afford to set up their own research laboratories, they can outsource their research work. So there also we had different percentages. Over a period of time, the weighted deduction is totally stopped. As of now, you should remember that 100% deduction is allowed. But just I'll make you understand that somewhere in few of the sections, in the past, weighted deduction was allowed. See, outsourced research involves two things. One important point, keep it in your mind, saying that if you are doing an in-house research, that research should be related to your business. In other words, if you are into a textile, you cannot do research in defense. If you are into textiles, you cannot do research in the field of defense because it is not related to your business. Correct? Huh? So if you are doing an in-house research, research should be related to your business. In case of outsourced research, actually this is not covering only the outsourced research. This is also covering donations. For example, as an individual, I have went through one report. I came across one report which says that India is not a secured country, meaning thereby we don't have the adequate amount of investment in defense equipments. So our borders are not secured. People from other countries can easily get into this country without any documents, etc. Our borders should be secured. See, we have a dangerous neighbor, China, etc. So defense wise, they are much advanced as compared to India. So we should also have advanced defense equipment. We should also have better quality of fighter jets. See, last fighter jet was purchased 15-20 years back, that MI fighter jets. the aircraft, the Indian Air Force, within the Indian Air Force, they say that Mi aircraft is a, if you fly an Mi aircraft, so there are brighter chances that it will crash, because those are 20-25 years old. So you are risking your life by flying that aircraft. That is the reason government in last 4-5 years have invested heavily in the defense equipment. Now say for example, as an individual, I feel that India has invested very less amount of money in defense. So India should be a secured country defense wise. I am having huge amount of money. Just to help the country, I have donated 50 crore rupees. I have donated 50 crores to government organization called as DRDO. Are you aware about DRDO? Defense Research and Development Organization. They are into research related to defense. See, I am not into defense business. I am into a textile business. But I just want that my country should be secured. That is the reason I have just donated money to DRDO. So when I donate money that the entity to whom I am donating money will not do research for my business. See, if you donate money to DRDO, they will do research in defense. My business may or may not be related to defense. Are you understanding? So when we talk about the outsourced research, it can take two forms. Number one, you have outsourced the research to someone, and that research is related to your business. That research is related to your business. The other one is donation. So actually you are not doing any research, but you are donating money to some institutions who are into research. And that when you give donation, the other entity which is doing research, he may or may not do research in the business in which you are engaged. For example, I am into a coaching business. I have donated money to DRDO just to ensure that India becomes a safe country. So my objective is not to do research in my business. My objective is to just give donation to the DRDO so that India becomes a secured country. So when we talk about the outsourced research, it can take two forms. Number one, I am getting my research work done by some third party, and number two, it can take the form of donations. Both will be allowed as deduction. So contribution to third party, also called as outsourced research expenses, and also called as donation to third parties. So even if you donate money for research, the donations can also be claimed as deduction. For example, you are a very rich person. Say for example, Manoj is having a net worth of say 5,000 crores. He is having a net worth of 5,000 crores. In the last April, the pandemic started. So Manoj decided to donate 100 crores for doing research for the vaccines. So he is giving donation. He is no way concerned with that vaccine business. He is just giving donation to help the people. So that also he can claim it as deduction. Outsourced research can be divided into two. Either it can be in the nature of a scientific research, or it can be the nature of social or statistical research. For example, have you seen that Harpic ad? Television actor called as Hussain. You might not be aware. Hussain went to Akshay Kumar, but Hussain ad was more famous. So he would visit each and every house and he would take the interview. So are you using Harpic, etc. So he is also doing a research. Which research? Statistical research. It involves numbers, statistics. So it is a market survey. Do you understand market survey? Market survey is also a research. Which research it is? Statistical research. So research can be either scientific or social research or a statistical research. Scientific research, everywhere as of now 100% deduction is allowed. As of now, everywhere 100% deduction is allowed. In point 3 earlier, 200% deduction was allowed. In point 1, 175% deduction was allowed. In point 2, 125% deduction was allowed. Just in the last 2-3 years, now they have reduced from 175, 125, 200 to 100. So as of now, you can just remember 100. See, market survey is part of a statistical research. There? No. Business organization doing research for their own product as to how many people are using our product and how many people are not using it. That is also a research that can also be claimed as research. Even if this section would not have been there, that cost would have been claimed as section in section 37 subsection 1. Correct? Huh? Last part, social and statistical research. Earlier, here 125% reduction was allowed, but now it is reduced to 100%. So now, listen to me carefully. Now, everywhere 100% reduction itself is allowed. So you need not remember the percentage, but very important point to be noted here is you should remember that outsourced research, there is a list of institutions. Only to them, if you give money, then only you can claim reduction. Those institutions should be approved. They should be registered in the respective sections. So I'll just refer it once. Amount contributed to approved scientific research association or university or college or other institution. See, there are a lot of universities also, they are into research. In university, few students might be doing the PhD courses. The student undergoing a PhD course will be required to do the research and will be required to submit the thesis. Then only he will get a PhD qualification. So, for example, in Mumbai, we have a university called as UDCT. We have a university called as UDCT. They are into chemistry. It is a university of chemistry. So, people who are doing, say, PhD from UDCT might be doing some research in chemicals. They might be doing some research in chemicals. So, UDCT is an approved university for a chemical research. So, if you donate money to UDCT, you can claim it as deduction in section 35, subsection 1, clause 2. Or you give money to any approved Indian company whose main objective itself is to do the research. Or you give money to national laboratory. The national laboratory is a laboratory set up by the government of India. University, Indian Institute of Technology, etc. Even if you don't remember everything, just remember 2-3 things. Number one, approved. The word approved should be there. If it is unapproved, you are not going to get any deduction. So it should be either approved research association, approved college, approved institution, or 2 extra points you can remember, national laboratory or Indian Institute of Technology. 5 points just you remember, you will remember everything from the left hand side. Right hand side also it is same. Approved research institution, approved college, approved university or approved institution. So just focus on approved word. Just remember the approved word. Besides that you remember national laboratory and IIT, that's all. I'm not getting a voice clearly. Whether 112 is capital gain. Deduction. 112. 112A, 112 that is related to capital gain. Why those sections will apply here? Please be silent. Please be silent. I'm not understanding. Tell me. No, there are no deductions in section 112A. That is what I am telling. In section 112A or in section 112, there is no deduction. It is not a section relating to deduction. It is a section relating to calculating the tax liability. So, I do not know what you are trying to say. Are you referring to section 112 or 112A? And if you are trying to connect that to section 35, section 35 do not have any connection with section 112, 112A. Section 112, 112A is giving you the tax rate for charging tax on long-term capital gain. It doesn't have any connection with this section as of now. Is that very clear? Have you understood this very clearly? We'll get into that. The point which you are saying, I think if you have acquired an asset, you have used it for scientific research. In the future, if you sell that asset and if there is a gain on sale of that asset, there can be capital gain. If you are thinking about that, that will come at a later stage. But as of now, we are talking only about the deduction, not about the capital gain or profit, etc. Is that very, very clear? So, in this, you have to just remember how many words? 5 words. Number 1, approved research association, approved college, approved university, national laboratory, Indian Institute of Technology. That's all. Because everywhere, as of now, the deduction is 100%. Now, remembering this section has become very easier from last 1920 onwards because they have reduced the percentages. Now, we need to get into the most important aspect of this section. Listen to me very carefully. I have taken the example here on page number 123. Page number 123. See, this would require application of mind. So, a lot of focus is required. Listen to me very carefully. I have taken 3 different examples to make you understand the entire concept. See, whatever expenditure you incur on a research, now you have come to know that capital expenditure on a research can also be claimed as deduction, and the deduction would be 100%. Yes or no? Ideally, if you incur a capital expenditure, what do you do about that? In the accountancy, you debit that, you take that capital expenditure to the balance sheet asset side, correct? So, in the balance sheet asset side, you will write the value of assets. But if those assets were acquired for doing scientific research, that doesn't mean that your accounting will change. Your accounting will be, accounts will be made as per the accounting rules. So, if you have acquired an asset and that asset is being used for scientific research, in accounts, those assets would appear in the balance sheet asset side. But in income tax, while you compute your PGBP income, your starting point of solution will be what? Net profit as per profit and loss account. Do you believe that this capital expenditure incurred for acquiring an asset which is to be used for a scientific research would have been debited to profit and loss account? If you have acquired an asset and the intention is to use that asset for scientific research, do you believe that the cost of asset would have been debited to profit and loss account? No, not at all. That would appear in the balance sheet asset side in the form of an asset. But government says the cost of that entire asset we are going to give you as deduction. So what you will do while computing your business income? No, you can't debit the profit and loss account. You are not here to change the accounts. The starting point of a solution would be what? Net profit as per profit and loss account. Whatever you want to do, you have to do in the form of adjustment. So now my question is, you have to do certain adjustment to the net profit, correct? So capital expenditure incurred on a research, in the accounts it is appearing in the balance sheet asset side, but while computing income under that PGBP, government says in section 35, we are going to give you a deduction. We are going to give you a deduction, meaning thereby what? While computing income, this cost of an asset will be allowed to be deducted. So in your net profit, is that deducted? No, because that cost is not debited to your profit and loss account. Correct? So in adjustment, what you are going to do? You are going to deduct. Yes or no? Now, have you understood this much? If clearly, then only I can proceed. Once again, I am repeating. If you have not understood, once again I am repeating. If you have understood, revision for you. Capital expenditure incurred, never it is debited to profit and loss account. It will always appear in the asset side, balance sheet on the asset side in the form of an asset. But in section 35 under that PGBP in the Income Tax Act, government says any capital expenditure incurred on a research, the entire cost of an asset will be allowed to you as deduction while computing your business income. But when we start the computation of business income, the starting point of our solution is net profit as per profit and loss account. If I ask you a question, what is the effect on this net profit of that capital expenditure incurred on a research? Do you believe that while calculating net profit, that capital expenditure incurred on a research is deducted? So what effect is gone? Plus effect is gone, or minus effect is gone, or it is ignored? It is ignored, so no effect is gone, correct? But government says we are going to give you deduction. So what effect should go? Minus effect should go, but it has not gone. So what you will do? You will deduct. Are you understanding? Keeping in mind this much, we are going to understand the example. Now, case by case, we will have a look at it. Case 1, your starting point of solution is what? Net profit as per profit and loss account. See what we are discussing now. I have not told you the topic which we are discussing intentionally. But have you realized that section 35 deduction part is over? Deduction part is over. So you can claim deduction for research cost. In-house research cost can also be claimed as deduction. Donations or the outsourced research cost can also be claimed as deduction. Right now that research deduction is already over. Now we have moved on to separate part to understand something else. I have not discussed what is the topic. Just I am discussing the procedural aspect with you. The starting point of solution would be what? When you calculate your PGBP income, starting point of solution will be net profit as per profit and loss account. To that net profit, you are going to do 4 types of adjustments. Expenses debited to profit and loss account, disallowed or considered separately. Taxable business income not credited to profit and loss account. Then expenditure related to business not debited to profit and loss account will be deducted. Yes or no? So 2 adjustment relating to additions and 2 adjustment relating to subtraction. We discussed this procedure yesterday, na? Yes or no? So say for example, related to additions, whatever adjustments are there related to additions, the total of all the addition related adjustment comes out to 100. Total of all the addition related adjustment comes out to 100. So 100 is required to be added. Similarly, whatever adjustments are required to be deducted, total of all those adjustments relating to subtraction comes to 50. So you will deduct 50. So you started your solution with net profit as per profit and loss account. Addition related adjustments you have done to the tune of 100. Subtraction related adjustment you have done to the tune of 50. And the amount which is arrived, generally that amount is called as PGBP income from business profession. But in this, still we have not given the effect of scientific research deduction. In 12th standard final accounts, I do not know the syllabus of state board here, but generally everywhere 12th standard we have an accountancy, you have a final accounts chapter which would be around 20 marks, and in that final accounts chapter there is an adjustment called as manager's commission is 5% of profit. So when you come across that adjustment, that adjustment you will not do at the beginning only. You will do that adjustment in the last term, because that net profit will not be given to you in the question. You have to ascertain the net profit. So you will do the posting for the entire trial balance. You will do the adjustments. Then you will close your trading account. You will transfer the gross profit to the profit and loss account. Then you will take the total of the credit side of P&L, total of debit side of P&L, and from the total of credit side you will deduct the total of debit side. The amount which is arrived will be called as a net profit before commission. Then you deduct the amount of commission to arrive at the amount of net profit after commission, correct? In other words, that manager commission adjustment will be done at the last. Similarly, this adjustment of scientific research will be done at last. So before doing this adjustment, you should do all other adjustment. Is that very clear? So the amount of 150, you are understanding now? Oh, yes or no? Amount of 150 will be called as PGBP income before claiming deduction under section 35. So this is the amount of profit before deduction under section 35. Now you see how much is the amount of expenditure, how much is the amount of capital expenditure which you have incurred on a research. So go to the balance sheet asset side, find out which are the new assets acquired, and find out of that how many assets are related to research and you acquired only with the intention to do the research. That amount of capital expenditure, you should claim it as deduction here. For example, the amount of capital expenditure is 100. So from 150, you deduct 100 and then you arrive at the amount of 5050. This is called as PGBP income after deduction under section 35. This is the final amount of income. Is that very clear? Now, do you have any doubt? See, because, one second. Have you understood what questions he has asked? Why we are doing the adjustment of scientific research at last? Is there any reason behind it? Now have you understood the question? Why we have not deducted the expenses here? Why we have not deducted the expenses here? And why we are deducting the expenses at a later stage here? That is what is the question. Have you understood the question? Yes or no? So the answer is, and that is what I am trying to explain in further part of the case, that second case, third case, that reason is going to come. The answer is, if you don't have the adequate amount of profits, the entire cost which you might have incurred will not be allowed to as deduction. You would not be in a position to claim the deduction because you don't have sufficient profits. So the amount of capital expenditure incurred on a research which you have not claimed as deduction because of insufficiency of profits, that portion will be allowed to you to be carried forward to the next year. And such carry forward is allowed for indefinite period of time. It is allowed for indefinite period of time. But if you have incurred loss in the business, that loss is also allowed to be carried forward in future. You can set off against some other positive income, but business loss carry forward is allowed only for 8 years. So there is a restriction. So in income tax, since there is a restriction to carry forward the business loss only for 8 years, and you can carry forward the unexhausted amount of capital expenditure on scientific research for an infinite period of time, we need to clearly make a distinction between the business loss and the unexhausted amount of research expenditure. So just because of the different rule for carry forward of loss, we are segregating it. Understood? So now in this first case, tell me what is the amount of profit? What is the amount of final amount of PGBP income? 50. So taxable PGBP income is 50. Do you have the business loss? No. Is there any portion of the expenditure? Is there any Paul? In this case, in the first case, what was the amount of expenditure incurred on a research? Amount of expenditure incurred on research was 100. Did you get the deduction for entire 100? Yes, because you had adequate profits of 150. So is there any amount which is not given to you as deduction? No. So deduction is allowed fully. So there is nothing left which is yet to be given to you as deduction. So the unabsorbed expenditure in this research is 0. If you have some unabsorbed amount, that will be carried forward for indefinite period of time. Is that very clear? Now move on to second case. Net profit as per profit and loss account is 100. Addition related adjustments are 100. Subtraction related adjustments are 50. And you have the PGBP income before deduction under section 35 to the you are having an amount of 115. Now if you have incurred the capital expenditure on research to the tune of 200, can you claim deduction for 200 here? No, because you don't have that much amount of profits in business. So to what extent you will be in a position to claim the deduction? Only to the extent of 150. So you claim deduction for 150. What is the amount for which you could not claim deduction is 50. So now in this case, do you have any taxable business income? No. Do you have any loss? No. This negative 50 will not be considered or will not be termed as a business loss. Because by doing business, you have not incurred a loss. You had a profit of 150. The amount has turned out to be negative only because of claiming deduction for research expenses. So this negative 50 cannot be termed as a business loss. It is termed as a unabsorbed expenditure on research. So this 50 will be allowed to be carried forwarded for infinite period of time. Is that very clear? Now we move on to the last case, third case. See, we are discussing exhaustive list of 3 cases. Case 3, net profit is 100. So your starting part of the solution is 100. Addition related adjustments are 100. Subtraction related adjustments are 250. So what is the amount of PGBP income? Minus 50. Anyway, you are already into losses. So if you have incurred 100 rupees as cost on research, can you claim deduction? No. Because you don't have the profit only. Against what you will claim deduction? You don't have the profit. So if you deduct 100, the final amount will turn out to be 150 negative. But for income, in income tax, this 150 negative is not considered as a business loss. By doing the business, you had a loss of only 50. Remaining 100 loss is because of claiming deduction of scientific research expenses. So in income tax, we have to segregate this total loss of 150 into 2 parts. How much is the business loss and how much is the loss because of claiming deduction of scientific research expenditure? Why we are segregating now? Because the carry forward period is different. Business loss can be carried forward only for a span of 8 succeeding assessment years. The next 8 years. And unabsorbed expenditure on a research can be carried forward for infinite span of time. So in this case, do you have the business profit? No. Do you have the business loss? Yes. How much? 50. And what is the amount of unabsorbed expenditure on research? 100. So every case is a unique case. First case, you are having profits. First case, you are having profit. So you don't have loss, you don't have unabsorbed expenditure on research. Second case, in business you are having profits, but your profit has turned out to be negative because of scientific research expenditure, and you are having unabsorbed expenditure on research. In the third case, anyway you are into losses. So you are having business loss as well as the unabsorbed expenditure on research. Have you understood this? Yes or no? 100%. Oi, this side, last bench. Yes or no? Raise your hand at least, so I will come to know that you have understood. Now comes the real discussion. If you have doubt, please do ask right now. If you have not understood this, forget about the future discussion. Whatever we are going to discuss, you will not understand. If you have understood this much, then the further part is very simple. Is there any doubt? Sure? Okay. Now listen to me very carefully. Listen to me very carefully. See, out of 3 cases, can you tell me when, in which case you are having a unabsorbed research expenditure? Case 2 as well as case 3, na? Case 2 50 and case 3 100, correct? Now, you have doubt? Are you very much sure? Listen to me very carefully. Case 2, there is an unabsorbed research expense of 50, and case 3, there is an unabsorbed research expense of 100. What would be the treatment of this minus 50 and minus 100? This will be carried forwarded. Once it is carried forwarded, what we will do about this in future? We will try to adjust this negative against the positive PGBP income. Correct? Huh? Now the point is, you can carry forward this to the subsequent year. In the subsequent year, this unabsorbed expenditure on research, you can adjust against the PGBP income, but the condition is your research should continue in the second year also, na? What if you stop doing the research at the end of the first year itself? Are you understanding? If you stop doing the research at the end of year number 1 itself, then for year number 2, your door of section 35 is closed. Are you understanding? Since your door for section 35 is closed, you have already completed the research. Section 35 door is closed. Now you can't claim any deduction in section 35. Now what is the consequence? Listen to me carefully. Year number 1, you have incurred some cost on research. Year number 1, you started the research, and up to the end of year number 1, you have also completed the research. So in year number 2, no research activity will take place. So section 35 door is closed for you in year number 2. Now once the research is completed, whatever asset you had acquired for the purpose of research, what you will do about that asset? That asset can be of two different nature. For example, I have set up my own research laboratory. I am into a chemical business. I have set up my own research laboratory. I have appointed the scientists. I am paying salary to them, and they are doing research for chemicals. Now say for example, my research is over. While setting up the research laboratory, I had installed air conditioners. See, in chemical research, a lot of heat will get generated. In the laboratory, the temperature might be more than 100 degrees. So to ensure that the temperature is low, I will have to install heavy duty ACs. So I have installed air conditioners in my research laboratory. Now my research is over. So what should I do about these air conditioners which are installed in the research laboratory? I have two options. If this AC can be used in my office, in other words, it is having a alternative use. And if I intend to do the alternative use, I will transfer this AC from the research laboratory to the office. In other words, I am transferring an asset from the research use to the normal use. I am transferring the asset from research use to normal use. This is one possibility. This is possible only when the asset is having a alternative use. But say for example, for doing research, the microscope lens that is purchased. Once the research is over, this lens does not have any alternative use. You can't give this lens to the watchman of the company and say that if someone is coming from very far away, you look at it. This microscopic lens is an asset which is specifically acquired for research. Once the research is over, that asset is a useless asset for you. So what you will do about that? You will try to sell off that asset. So asset can be of two different nature. Specifically usable only for research, and all it is having alternative use, so it is an asset of general nature. If the research is over, then the asset which is a specifically of research nature use will be definitely sold off. Because you don't want to do any more research. And the asset which are having alternative use, you have two options. If you want, you use it in your business, or if you don't want, you sell it off. Is that very clear? Now the point is, Say for example, let us take an example of AC. AC was installed in a research laboratory. Research is over. Now we have decided to close down that research laboratory. So you have transferred this AC from your research laboratory to the office. In other words, this AC is transferred from research use to normal business use. When you acquire this AC with the intention to be installed in a research laboratory, you would not have added this AC to the block of asset. See, if you are allowed 100% deduction for the cost of asset somewhere, then on that asset, neither you are going to get the normal depreciation nor the additional depreciation. The additional depreciation, there are 5 points, 2S, 2O, and the last one is P. That point clearly said that if 100% deduction is allowed in some other section, no additional depreciation. If the entire cost of an asset is allowed as deduction in some section, like section 35, neither you can claim depreciation nor you can claim additional depreciation. Correct? So, the asset which was acquired for the purpose of research would not be lying in your block of asset, because it is not forming part of your normal asset, it is forming part of your research asset. Depreciation won't be allowed. Entire cost of asset will be allowed to as deduction in section 35. Now, my point is, research is over. This asset you are transferring from research use to the normal use. So, now this asset should form part of your block. Now, this asset should form part of your block. But the question is, how much value you should add to the block of asset? So, different situation for this. In case 1, what is the unabsorbed amount of research expenditure? 0. So, you had invested 100, you had acquired an asset of 100 for doing research, and the entire cost of 100 is already claimed by you as deduction in section 35. So, what lies unabsorbed is 0. So, if this asset research is completed and if this asset is transferred from research use to normal business use, what you will add to the block of asset is 0. You will not add any value, just quantity will be added to the block. Value will not be added because entire value is already claimed as deduction. In other words, I am trying to tell you that this unabsorbed expenditure is nothing but the balance of the cost for which you have not claimed deduction in section 35. So, if the research is over and you transfer the asset from the research use to normal use, this unabsorbed amount should be added to the block. So, in case 1, we will add 0 to the block. In case 2, we will add how much? 50 to the block. And in case 3, we will add 100. So, step number 1, listen to me very carefully. Once the research is over, if you transfer the asset from research use to normal business use, your first step is to add the unabsorbed expenditure to the block of asset, because now this asset would be forming part of your normal business use. Is that very clear? Now since the asset is forming part of the block, in future, if you sell that particular asset, will you calculate profit or loss separately? No, because once the asset gets into the block, it loses its individual identity. So, under what circumstance profit loss will be calculated? That we have already discussed in example number 1, 4 cases now. If your WDV turns out, WDV is positive and at the end of the year you are having assets in the block, then even if you have sold the asset, there will not be any profit or loss on sale of asset. You will calculate depreciation. Second case, if your WDV has turned out to be negative, it indicates a short-term capital gain. Third case, if all the assets from the block are sold, then either you will have short-term gain or you will have short-term loss. So, moral of the story is, the asset which was acquired for research is over. Now you have transferred the asset from research use to normal use. Then you have to follow 2 steps. Step number 1, add the unabsorbed amount to the block of asset. This will be done in the year in which the asset is transferred from research use to normal use. And in future, if you sell this asset, then in the year of sale of asset, the selling price will be deducted from the value of the block. Thereafter, you may have depreciation or you may have short-term gain, short-term loss, depending upon whether you are falling into case 1, case 2, case 3, case 4 of that first example. Do you recollect that? Now, let's move on to the last part of the discussion of this section. You have acquired an asset for research. Your research is over. Now, either the asset is a research specific asset, so you are forced to sell off the asset, or asset is a normal asset, so it is having a alternative business use, but you don't intend to put it to a alternative business use, so you have decided to sell off the asset. See, even if it is an asset of general nature, it is not necessary for you to put it to a alternative use. If you want to sell, you can sell it off. If you sell that asset, you are going to realize some amount of money. Now, this asset which is sold is not forming part of the block. So, what treatment you should give? The treatment is same as which we had discussed in case of profit loss calculation on transfer of asset by a power generating unit. Do you recollect? Selling price is more than WDV, selling price is less than WDV. I had taken 3 different examples now. Asset costing 1 lakh was acquired, depreciation was claimed 2 years 10,000 SLM. Do you recollect? Same treatment is required to be given. Means selling price will be compared with WDV. If selling price is less than WDV, then it is what? If selling price is less than WDV, then it is what? In simple language, it is nothing but loss on sale of asset. That loss will be allowed 2 years deduction in section 35 in the year of sale of asset. That loss will be allowed 2 years deduction in which section? Section 35 in the year of sale of asset. Is that very clear? But the question is, if you sell the asset, you are going to realize money, and that amount of money which you have realized is your selling price. Is your selling price. But what is the WDV? WDV is nothing but the unabsorbed expenditure. WDV is nothing but the unabsorbed expenditure. What is unabsorbed expenditure? The amount of cost for which you have not got any deduction in section 35. So that unabsorbed amount is as good as WDV. So in the first case, what is the WDV? 0. So no WDV. So in this case, if we fall into the first case, then entire selling price would indicate a profit only, because the WDV is 0. Are you understanding? Second case, what is the WDV? 50. Third case, what is the WDV? 100. Is that very clear? So if you sell the asset which is used for research, if you are going to sell it, then the unabsorbed amount would be considered as a WDV that would be compared with the selling price, and the profit or loss on sale of asset will be calculated. See this part now. Sale of asset used for scientific research. Sale of asset used for scientific research. This is divided into asset is sold after using for other purposes. Asset is sold, but first of all it was put to a alternative use, normal business use. Later on it was sold. So you have to follow 2 steps. Step number 1, add the value asset to the block asset. What is that value? Nothing but the unabsorbed expenditure on research. This step number 1 will be given effect in which year? In which year in which you are transferring the asset from research use to normal business use. Yes or no? Step number 2 will be given effect in the year in which you have sold the asset. When you sell the asset, now this asset is forming part of a block. So on sale of asset, profit loss will be calculated as already discussed in case 1, case 2, case 3, case 4 of example number 1 on depreciation. Do you remember that example? Second part is asset is sold without using for other business purposes. In that case, what is your WDV? Unabsorbed amount is your WDV. Now you take that unabsorbed amount as WDV and you compare it with selling price. If the selling price is less than WDV, there is a loss on sale. This loss on sale will be allowed to a reduction under that PGBP in the year of sale. Under which section? 35 only. Is that very clear? On the other hand, if the selling price is more than WDV, then you have to find out whether the selling price is also more than the original cost or not. If selling price is more than WDV, but it is not more than the original cost, then you will have a profit on sale. This profit on sale will be taxable in section 41 subsection 3. So in case of power generating unit, the section was section 41 subsection 2. Here it is subsection 3. Last part, selling price is more than WDV, it is also more than the original cost. In that case, original cost minus WDV. Original cost minus WDV will become taxable in section 41 subsection 3 under that PGBP. It will indicate your revenue profit. And the second part, that is the extent to which your selling price is even more than your original cost, that indicates that it is a capital profit. It will become taxable under that capital. So you will have to calculate capital gain, and that capital gain, if it is long term, tax rate would be as per section 112. If it is short term, it would be taxable at normal rates. But in any case, section 112A will not apply. See, this something which I told you related to capital gains, you may not understand right now. November 21 students learning income tax for the first time may not understand this. Forget about it right now. When we get into capital gain, once again we'll have a reference to that. So with this, we have completed section 35 entirely. On that section 35, we have a very small question here, question number 8. You want me to discuss right now? So that we'll complete this section. Then we'll have a break and then we can have a new section. Question number 8. Mr. Praveen Kumar has furnished the following particulars relating to the payment made towards the scientific research for the year ended 31st March 21. We are on which page? 123. Payment is made by him to K Research Limited. Payment is made to K Research Limited, 20 lakhs. Payment is made to LMN College, 15 lakhs. Payment is made to OPQ College, 15 lakhs. Now the note says K Research Limited and LMN College are approved research institutions, and these payments are to be used for the purpose of scientific research. So how much deduction will be allowed? 100% deduction will be allowed. But very important point to be noted is, they have clearly told you K Research Limited and LMN College are approved. In other words, indirectly they are telling you that OPQ College is not approved. See, even if OPQ College would have been approved, they would have given that in the note only now. They have not given, means OPQ College is not approved, means this 10 lakhs cannot be claimed as deduction. This 10 lakh cannot be claimed as deduction. Payment to National Laboratory 100% deduction. So everywhere deduction is 100% only. Everywhere deduction is. Payment to National Laboratory 100% deduction. Machinery purchased for in-house research, that is also 100% deduction allowed. Salary to research staff engaged in in-house research, for this also you can claim 100% deduction. So point number 5 and point number 6 are about the in-house research, and point number 1, 2, 3, 4 is outsourced research, or we can say it is a donation to outside. Compute the amount of deduction available under section 35 of the Income Tax Act. So you take the total of everything except the third point, that is 10 lakhs. So 20 plus 15 is 35. 35 plus 8 is 43, plus 25, 48, 58, 68, plus 12, 80 lakhs. 80 lakhs. It is 80 lakhs. Yes or no? So a deduction under section 35. $80 lakhs. Is that very, very clear? So with this we have completed one of the big section of this chapter, section 35, scientific research. Today, as I told you, I will be postponing the discussion of section 35AD. You all have, those who have not gone through the section 35AD will have one more opportunity to get it through it. Tomorrow I will cover up this section 35AD also. So today after the break, I will move on to other sections and we would be starting with section 35D. Shall we proceed? So, we move on to page number 127. Page number 127. Section is section 35D. It gives you deduction for preliminary expenses. Our discussion in this section would be divided into certain parts. Part number 1, what is the meaning of preliminary expenses? See, you might be knowing the general meaning of preliminary expenses, but section 35D may or may not have all the points which you might be having in your mind, considering what you had learned with respect to preliminary expenses, bookkeeping and accountancy. Here we have specific points in the meaning of preliminary expenses. So part 1 is meaning of preliminary expenses. Part 2 is purpose of preliminary expenses. If the preliminary expenditure is incurred for a specified purpose, then only deduction is allowed. Don't talk. So part 1 is what? We'll understand meaning of preliminary expenditure. Number 2 will be learning what? Purpose. What is the purpose of preliminary expenditure? Number 3, who all are the SSEs who can claim the deduction? Number 4, is there any maximum limit for claiming deduction, or you can claim deduction for unlimited amount? That is what we'll be learning in part 4. And part 5, manner of claiming deduction. Manner of claiming deduction will be means will you get deduction for the entire amount in 1 year itself, or you will get deduction in installments. All these things we'll understand. Besides, last thing which we'll be understanding is how the deduction will be allowed in case of business restructuring like amalgamation, demerger, etc. So in this 6 parts, basically 5-6 parts, will be understanding the entire section. First of all, let us get into this point number 3. Point number 3 is meaning of preliminary expenditure. Point number 3 is meaning of preliminary expenditure. We have a list of 6 points. Only these 6 points are considered as preliminary expenditure. So you may have some extra points in your mind which you might have heard in accountancy. Those all are definitely covered. If at all there is something which is not covered here, no deduction under section 35D. 35D is an exhaustive section. It gives you only 6 points. First point, legal expenditure for preparation of an agreement for setting up of business. See, when the company is formed, an agreement is entered with the promoter of the company. Agreement is entered with the promoter of the company. Promoter of the company will incur all the expenditure. Once the company is formed, the entire expenditure will be reimbursed to the promoter. So, for making that agreement itself, you need to incur the legal expenses. So, you may appoint a lawyer, etc., and he may make an agreement. For that, you are going to pay some professional fees to that lawyer. That professional fees, also called as legal expenses, would be forming part of the preliminary expenditure. Number 2 point is very important. You can mark this as very important point. Day before exam, you need to revise this, otherwise you are going to do a mistake in the examination. Number 2 point itself covers 4 expenditure. Point number 2 covers how many expenditure? 4 expenditure. Number 1 is cost of preparation of feasibility report. Do you understand feasibility report? Generally, big business organizations, before expanding their businesses or before starting any new business, they would get that feasibility report as to whether this business would be feasible or not feasible. Whether this business would be feasible or not. Feasible means financially viable or not. Number 2 is project report. In project report, some consultancy firm will be appointed and will ask them that if we set up so and so business in so and so locality, how much business we can get? How much business we can get? For example, which other city is there in Tamil Nadu other than Chennai? Coimbatore. For example, Inside Commerce Studies wanted to expand in the city of Coimbatore. That doesn't mean that we'll invest huge amount of money and then we'll realize that there are less CA students in this city and there is no point in setting up the class there. Before we set up the class itself, we'll appoint a third party research agency, survey agency. That research agency will do what now? They will they'll do a market survey on our behalf. They'll do some survey, they'll collect some data. They'll collect the data. There are how many students in the city of Coimbatore, CA students, how many are CA foundation students, how many are intermediate students, how many are CA final students, plus out of the total number of students, how many of them are joining coaching class, how many are preparing on their own. Thereafter, there are how many other coaching classes already doing business in the city of Coimbatore, how much business they are getting, what are the chances that if we set up the branch, we will also get the business. If we get the business, how much business on an estimated basis we will get. So all these things they will find out on our behalf and they'll make a report and they'll submit us the report. They'll give us the report. Based on that report, we would take the decision as to should we set up the branch in Coimbatore or not. So before doing any project, the first step is to get the project report. Based on the project report, you will take a business decision as to set up, as to go for that project or not. So feasibility report looks after the financial aspect of the business, whether financially this business would be viable or not. Project report will look after other aspects other than finance, like what is the total market of the entire product, there are how many competitors, if we enter into business we'll get how much market share, all those things will be looked at. So cost of preparing a feasibility report, cost of preparing a project report, expenditure incurred for conducting any survey including market survey. Expenditure incurred for conducting any survey including market survey. Do you recollect one of the example which I had given you while explaining you section 9? Section 9 explanation 3a, I gave you example of Facebook saying that I connected that example to a shoes manufacturing company. There was a sports shoes manufacturing company. They wanted to set up start the business in India, but what they did before they entered India, they got the survey done from the Facebook. They made a questionnaire wherein every person who is having an account in Facebook, Indian account opened from India, then in that case on his screen a survey would appear, and unless and until you fill up the survey, you will not be allowed to log in your account. So that survey cost which is incurred is also called as preliminary expenses. So survey cost of getting the survey done or cost of getting the market survey done will be part of the preliminary expenditure. Fourth one is engineering services. Fourth one is what? Engineering services. Engineering services are generally in connection with installation of plant machinery, etc. So there are how many expenditure covered by point number 2? 4 expenditure. Number 1, cost of preparation of feasibility report. Number 2, cost of preparation of project report. Number 3, cost incurred for getting the survey done including the market survey. And number 4, engineering services. These 4 expenditure would be considered as part of preliminary expenditure, will be allowed to as deduction provided this cost you have incurred on your own. Either SSC himself has incurred the cost, in other words he has done these activities done by his own through his employees, etc. So SSE himself has done these activities by incurring the expenditure, or he has got these activities done from any institution which is notified by CBDT. So there are two possibilities. I will do survey on my own. Say for example, inside Commerce Studies, the same example, they wanted to start a branch at Coimbatore. So from our team only, we will send one person to Coimbatore. He will travel throughout the city. He'll try to find out there are how many coaching classes, how many students. He'll conduct the survey. So he's our person only. We are paying them. We are paying him a salary. So we are doing this survey done on our own. Or if we don't want to do the survey on our own, we can get this survey done through the outside agency. In that case, we should appoint an agency which is approved by CBDT. If you appoint an agency which is not approved by CBDT, you are not going to get any deduction for that expenditure. That won't be forming part of your prelim expenditure. Have you understood this? So this point number two, this all activities should be carried on by the SSE or concern notified by CBDT. This part is very important. This cost should be incurred by the SSE himself, or this work should be done through a institution which is approved by CBDT. In other words, you are getting this work done from any other institution which is not approved by CBDT, you are not going to get any deduction. Have you understood this? So you mark this as important point. Day before exam, you have to refer to these 4 expenses, and you need to remember that deduction will be allowed only if the SSE himself incurs the expenditure or he gets the work done through the institute which is approved by CBDT. Next is legal expenditure for preparation of memorandum and articles. See, every company would be required to make memorandum and articles of association, no? But the promoter of the company would not have the knowledge, how to make. Every promoter is not a qualified person. He might be knowledgeable person in his own field, but he may not be qualified that much that he'll be in a position to make the memorandum and articles. So he may appoint a company secretary to do this work, or he may appoint a lawyer. Lawyer will make the memorandum of association and articles of association. For drafting that memorandum and articles, he'll have to pay, and company would be required to, promoter will be paying a legal expenditure. He'll be incurring a legal expenditure. That would also be forming part of the prelim expenses. Cost of printing memorandum and articles. See, point number 3 and 4, what is the difference? Point number 3, cost is incurred as a legal expenditure for making the memorandum and articles. The point number 4, it is a printing cost. It is a printing cost. So that printing cost you cannot debit to your profit and loss account considering as part of printing and stationery. This printing cost of memorandum and articles should be claimed as reduction in section 35, not in 37(1). Is that very clear? Registration fees paid for incorporation. When you incorporate any company, you have to register the company with the Registrar of Companies, Ministry of Corporate Affairs. So to the registrar, you have to pay certain fees for registration. That fees which is paid for the registration of company would also form part of preliminary expenses. And the last one is expenditure incurred in connection with public issue of shares and debentures. Can you tell me what is the expenditure which you may incur as part of in connection with the issue of shares and debentures? What different expenditure you may incur? For what? Listing. For listing, you pay fees to stock exchange, not to the SEBI. You may incur something called as underwriting commission. You may appoint the underwriter, na? You will be allowed to issue the shares only if your shares are subscribed to the tune of minimum 90%. All these conditions, are you aware about it? In the issue of shares chapter, it might have been covered somewhere in CA Foundation, right? In case of under subscription, you will not be allowed to raise the capital. So your issue should be fully subscribed. So you are having a risk of under subscription, you will appoint a underwriter. Yes or no? So, in connection with public issue of shares and debentures, you may incur lot of cost. Number one is underwriting expenses. There can be other cost like advertisement cost. See, you need to make public aware now that we are coming out with an IPO and subscribe. So you may incur some advertising cost. All this would be forming part of your prelim expenses. All these are expenditure in connection with issue of shares and debentures. For example, underwriting commission, number two, brokerage and charges for drafting, typing, printing and advertisement of the prospectus. We make the prospectus, then the prospectus is circulated between the investors, in the general public. The people will refer to the prospectus, then they'll, if they feel that the company is good, the business is good, then they would be investing money. So all this cost would be considered as what? Would be considered as preliminary expenses. Have you understood the meaning of preliminary expenses? Now I think by referring to the 6 points, now we will not have any expenditure which you can think of that yes, this is a preliminary expenditure, but it is not covered in the list of 6 points. Mostly all the points are covered. If at all you have some other expenditure, then that would not form part of preliminary expenses. So point number 3, meaning of preliminary expense is over. Now we move on to second point, purpose of preliminary expenditure or objective of preliminary expenditure. Here we say that if the preliminary expenditure is incurred in connection with commencement of new business, it is incurred in connection with commencement of new business, then deduction is allowed. Second possibility is business is already commenced. Business is already commenced. Thereafter, if you want to expand the business, then also you will need funds now. So you may raise the funds from the public by issuing the shares with the intention to expand the business. In that case, whatever expenditure you incur in the form of preliminary expenditure can also be claimed as deduction. So after commencement of business, preliminary expenditure still can be claimed as deduction if it is incurred in connection with extension of existing undertaking. Extension means nothing but expansion. Or if the preliminary expenditure is incurred in connection with setting up a new undertaking. Setting up of new undertaking. For example, Inside Commerce Studies is into the business of coaching. So they would provide coaching to the students and they would get fees and they would earn money out of that. Now, for example, all the faculties which are visiting Inside Commerce Studies, Tarun sir observed that every faculty, they have made their own notes. The content of the notes is good. The language is very simple. Notes are full of flowcharts, etc. So Tarun sir said that he had a meeting with all the faculties and he said that besides providing the coaching, I intend to get into the field of printing and publishing. So we would ensure that we publish the books for different subjects and we will sell the book throughout the country. Thereby, by selling the books also, we will have good amount of revenue, and that revenue I will be sharing with all the teachers. So he is having an intention to get into a slightly different business, printing and publishing business. Even though it is connected to the coaching business, but it is altogether a different business that would require a factory, that would require printing machines, etc. So he decided that yes, he want to get into that printing publishing business. So he raised the funds for that. He might have incurred some expenditure called as preliminary expenditure. That preliminary expenditure can also be claimed as deduction because that preliminary expenditure is incurred in connection with setting up of new undertaking. So three objectives are covered here. Either we incur the preliminary expenditure for what? For commencement of new business, or after commencement of business for expansion of existing business, or for setting up a new line of business, separate line of business, separate undertaking. Have you understood this? Now, I'll give you one example to make you understand that there are certain situations, not important at IPCC level, but still I am sharing with you. There are certain situations wherein you are not allowed any deduction with respect to preliminary expenses. Why not? Because those preliminary expenditure is incurred for a purpose which is not covered here. For example, in financial management subject, you might have heard something called as cost of capital chapter. Na? Every fund which you raise will be having a cost. For equity, dividend is a cost. For debentures, interest is a cost. Ideally, when a business organization should raise funds through debentures and do the business, when the return on his investment or return on his equity in the business is more than the rate of interest of debentures. Yes or no? Debentures have raised, funds have raised through debentures at 11% interest, and in my business, return on my investment is 8%. Then definitely there is no point in raising the funds and expanding the business. Yes or no? Now, for example, say for example, some company had taken loan for expansion of business, and that loan was taken at the rate of 12% per annum. And they were expecting that these funds will be utilized for expanding the business, and business will be expanded more. We will sell more goods, there will be more revenue, and there will be more profits. So we'll be in a position to easily pay off the interest to the bank, because return in our business is much more than the interest cost. But due to this pandemic, their business is not growing as expected. They have already issued the debentures, they have already raised the funds, they have already set up the branches, business is already started, but because of pandemic, the revenue is not increasing. So the situation is not as they had expected earlier. So return on their investment has fallen below say 10%, and they are now required to pay interest on debentures at the rate of 12%. So they are losing now. So what alternative approach they have thought is, we'll do one thing, we'll raise the funds through issuing the shares. It is not mandatory for a company to pay dividend now. Only if the company is into profits, they will pay dividend. So funds are already raised through debentures, or maybe for example, loan is taken from bank. It was invested into the business, considering that we will easily earn more than the interest cost. But due to this pandemic, the business is not growing as expected. But the fund which is borrowed from the bank, they are already invested into business. I have set up a branch, I have purchased different assets. Now interest cost has become a burdensome for me. So what option I am having? I can issue the shares, raise the funds, and use these funds for repaying the bank loan, thereby making my interest cost to be taking my interest cost to zero. So my intention of issuing the shares and raising the funds is what? My intention of issuing the shares and raising the funds is to repay my borrowed funds, so that the interest cost dips to zero. Thereby nothing will be debited to my profit and loss account in the form of interest on loan. Thereby my profit will increase. So if I issue the equity shares and if I raise the funds, definitely I am going to incur some preliminary expenditure. The purpose of raising the funds was to repay the bank loan. So the question is, can I claim deduction for that preliminary expenditure which is incurred for raising the funds or issuing the shares? Yes or no? Have you understood the question? I have incurred some preliminary expenditure. For what? For issuing the shares. The funds which will be raised by issuing the shares is going to get utilized for what? For repaying the bank loan. So my question to you is, I have incurred the preliminary expenditure for issuing the shares, for raising the funds through equity. So can I claim deduction for that preliminary expenditure? Yes or no? Have you understood the question? So the answer is you can't claim deduction for this preliminary expenditure. Why? Why? Because the purpose of preliminary expenditure doesn't fit into the purpose which is given here. Have you incurred the preliminary expenditure for setting up a new business? No. Have you incurred the preliminary expenditure for expanding the existing business? No. Have you incurred the preliminary expenditure for setting up a new undertaking? No. So the purpose of incurring the preliminary expenditure doesn't fit into any of these three purposes. Therefore, preliminary expenditure will not be allowed to you as deduction. Have you understood this? Have you understood? Do you need one more example or you have understood very clearly? Very superb. So point number 2 is also over. First point which we discussed was meaning of preliminary expense. Number 2 is purpose of preliminary expenditure. If the purpose for which you have incurred the preliminary expenditure falls within these three purposes, then only you can claim deduction for preliminary expenses. Is that very clear? Okay. Now we will discuss 3 points at a same time. We will discuss 3 points at the same time. That is point number 1, point number 1, point number 4 and point number 5. Point number 1, 4 and 5 will be discussed at the same time, and this point number 1, 4 and 5 is presented to you in the form of a flow chart in point number 8. So this flow chart we have covered 3 points. Point number 1, point number 4 and point number 5. These 3 points are covered here. See, instead of maximum limit, you can remove these words from here. Delete this maximum limit words. Instead of that, you write SSE. What do you write? SSE. So for the purpose of understanding, who can claim deduction, how much deduction, and what is the manner of claiming deduction, with an intention to understand 3 things. What is that? Who can claim deduction, how much deduction, and manner in which deduction can be claimed. With the intention of understanding 3 things, we have made this flow chart. Point number 8. Here we have divided the SSE into 2. Those SSE which are company and those which are other than company. If the SSE is company, they are further bifurcated into 2. Indian company, other than Indian company, non-Indian company. Non-Indian company or other than Indian company will not allow them deduction with respect to preliminary expense. Why? Because this non-Indian company might have incurred the preliminary expense outside India, wherever they are registered. Why should we give deduction in India? Correct? So non-Indian company won't get any deduction in connection with preliminary expense. Only Indian company can claim deduction with respect to preliminary expenses. Is that 100% clear? Now, how much deduction will be allowed? Meaning thereby, is there any maximum limit for claiming deduction? Or you can claim deduction for any amount? So government says yes, there is a maximum limit. But what is the quantum of point number 2? How do you ascertain point number 2? Point number 2 is higher of point A and point B. See, what is the quantum of deduction? What will be the quantum of deduction? Lower of point 1 and 2. And what is point 2? Maximum limit. Maximum limit is higher of point A and point B. Is that very clear? So point 2A, it says you take 5% of cost of project. What do you mean by cost of project na? The year in which you had incurred the preliminary expenditure na? At the end of that year you might have made your financials. Pick up the balance sheet of which date? Last date of the year. Which year? The year in which preliminary expenditure was incurred. That year's last date balance sheet you pick up. From the balance sheet asset side, you take the total of fixed assets. You take the total of fixed assets. That is called as cost of project. That is called as what? Cost of project. On that you apply 5%. On that you apply 5%. See, say for example, Tarun sir is making video lectures na, and he is selling video lectures throughout the country. He may sell the video lectures directly. He may approach the students directly. Means he may arrange the data of the students, mobile number of the students, email ID of students, and he may keep a team of 2 persons. They'll be flashing out messages to the mobile numbers of the student, saying that IDT subject, if you want to learn at CA intermediate, you can purchase the video lectures, etc., etc., etc. He can sell the video lectures directly approaching the students, or he can sell the video lectures through some agencies. Those agencies who do the advertisement for the faculties, they will incur the advertisement cost, and they'll do the online as well as offline advertisement, and they would sell the video lectures of different faculties. But those agencies would charge certain amount of commission. What should be the reasonable amount of commission? If some agency says we would charge you 90% commission, if you sell the video lecture at 4,000, 3,600 we will take, we will give you 400 rupees. Will you agree? You run away from it. So we will not get associated with some agency. We will have something in our mind, what should be the maximum amount of commission. There would be something in his mind that the maximum amount of commission should be 20% or 25%, whatever it is. Similarly, government is having a limit in their own mind, saying that preliminary expenditure should be maximum 5% of the total cost of the asset. It should not exceed 5% of the total value of the asset. If at all it is exceeding 5% of the total value of asset, then we will restrict your deduction up to 5% of the total value of asset. Have you understood this? So point A is 5% of cost of project. What do you mean by cost of project? It is nothing but the aggregate value of fixed asset as on the last day of the year. That is, you pick up the balance sheet, you take the total of fixed asset. Which year? Year in which preliminary expenditure was incurred. That will become your point number A. Then you ascertain point number B. What is point B? 5% of capital employed. See, this is not same capital employed which you used to calculate in accounts. In accounting, capital employed is something similar to this, but there is some change. How do you calculate or how do you ascertain capital employed in accountancy? You have two approaches, asset side approach, liability side approach. Yes or no? From the asset side, you pick up all the assets excluding fictitious assets, and from that you deduct the outside liabilities. You arrive at the amount of capital employed. The same capital employed, if you want to ascertain through liability side approach, you pick up the capital, to that you add reserves, and from that you deduct the miscellaneous expenditure, fictitious assets. You will arrive at the same amount. So for ascertaining capital employed in accountancy, you are having two approaches: asset side approach and liability side approach. Forget about the asset side approach. Just focus on liability side approach. In liability side approach, you will take the own funds, you will take the reserves and surplus, you will take the borrowed funds. From that, you will deduct the miscellaneous expenditure or any other fictitious asset from the asset side. This is the manner in which you used to calculate the, you would ascertain the capital employed in accounts. But here in income tax, the word capital employed is clearly defined. What all things will be included in capital employed now? Number one, issued capital. Which capital? Issued capital. Number two, debentures. Number two, see, everything is written. Still, if you want to write, you can. Small kid, na, when he learns for 1, 2, 3, 4 for the first time in his life, na, teacher will write once in a slate, na, then he will be asked to write on that. So this is what you are doing by copying. Everything is written here. I'll show. Listen to me, please. Instead of writing everything, you should respond whenever I am asking the questions. So I was telling you what all things are included in capital employed. Number one, what is included? Issued capital. Number two, debentures. I did not use the word reserves, na? For in income tax, for section 35 AD, prelim expenditure, capital employed is defined to include number one, issued capital, number two, debentures, and number three, long-term borrowings. In other words, reserves are not considered as part of capital employed here. In accountancy, they are considered as part of capital employed, but here they are not taken into account. Is that very, very clear? So this definition is given here. So once again, look here. Indian company can claim deduction for prelim expenditure. What is the quantum of deduction? Lower of following two amount. What is first amount? Actual prelim expenditure incurred. What is second amount? Maximum limit. How much is the maximum limit? Higher of 5% of cost of project or 5% of capital employed. That would become the maximum limit. That would be compared with the actual preliminary expenditure incurred. Then I will select whichever is lower. And that would be the quantum of deduction which I am eligible to take. That deduction will be allowed in 5 equal annual installments. Can you recollect any other point wherein the deduction was allowed in this manner only? Can you recollect any other provision wherein the deduction was allowed in this manner only? Income from house property pre-construction interest deduction, that was also allowed in 5 equal annual installments. This deduction will also be allowed in 5 equal annual installments. Is that very, very clear? So this left hand side part is over. Now we move on to right hand side. When the SSC is other than company. When the SSC is other than company, means he might be individual, HUF firm, etc. In that case, we would ask him, what is your residential status? We would ask him, what is your residential status? Why did not you ask the residential status on the left hand side? Indian companies always resident in India. Yes or no? Do you recollect? So for other SSCs other than company, you should ask the residential status. If they say that they are non-resident, then they are not eligible to claim any deduction with respect to preliminary expenses. Deduction for preliminary expenditure will be allowed only to resident SSCs. In case of other than company, deduction will be allowed only to resident SSC. If the SSC is resident, deduction is allowed. Now what I have done now? Same thing is copied from here. Same thing. What is missing here? 5% of capital employed point is missing. What do you mean by capital employed? What all things are included in capital employed? Issued capital, debentures, long-term borrowings. Do you believe in case of individual he will issue shares? Individuals, are they allowed to issue equity shares and raise funds? So this right hand side part is also applicable to individual now. So if you keep a point of 5% of capital employed, that would be invalid now. Because individual HUF, they would not be allowed to raise the funds through issue of shares and debentures. That is the reason that 5% of capital employed point is removed. So here we are having only 2 points. Number 1, actual preliminary expenditure incurred, and number 2, maximal made, which is 5% of cost of project. Cost of project is nothing but 5% of total value of fixed asset as on the last day of the year. Which year in which expenditure was incurred. Even the individual would be having a balance sheet now. So we have removed 1 point here, and that is 5% of capital employed, because it will not be there in case of individual HUF, etc. So point number 8 we have completed. In this point number 8 we have covered how many points? Point 1, point 4 and point 5. Point 1 is over, 4 is over, 5 is over, 2, 3 are already over. So now we are left with 3 points. Now we are left with 2 points. Point number 6 and point number 7. Listen to me carefully. Last 2 points, but most important. Point number 7 is most important. Before that, let us move on. Let us refer point number 6. Point number 6 is smaller one. Nothing to explain more. But here there is a budget amendment. Here there is a budget 2020 amendment. First of all, what point number 6 says? If the SSC is a person other than company, the SSC is a person other than company, or SSC is a cooperative society, and if they intend to claim deduction under section 35D for a preliminary expense, then they have to get their books of accounts audited. So if you intend to claim any deduction, why they have excluded company? Because company, in case of company, anyway their books of accounts will get audited. In case of company, anyway their books of account will get audited because of the Companies Act now. But others other SSCs, their books of account may not be audited. So government says, if you want to claim deduction for preliminary expenditure, your books of accounts are required to be audited by a chartered accountant, and you have to take a report from a chartered accountant. That report, he will calculate the amount of deduction which you are eligible for. And that copy of the report, listen to me very carefully. That copy of the report, which report? Audit reports taken from a chartered accountant. That copy of the report up to last year, it was required to be submitted along with your income tax return. It was required to be submitted along with your income tax return. Now in budget 2020, there is an amendment. See, practically none of you have filed income tax return even once in the life. You have not seen income tax return. You have different forms. There are different. The way you have an application form for submitting to the college for the admission. Similarly, for filing the income tax return also will have different forms. Now, what is the objective of the government? These forms we download from the income tax website. Every individual, every person would have a login ID and password in the income tax website. If you log in the income tax website, and then if you download the form, there will be certain rows which will be pre-filled. For example, your name will be pre-filled, your address will be pre-filled, your email ID, your mobile number, all this common data will be pre-filled. So the objective of the government is to ensure that most of the data should be pre-filled. So when you file the return, you are required to just punch very less amount of data. That is the objective of the government, and that they are going to achieve in next 2-3 years. So with that objective, keeping in mind that objective, now government has made an amendment in budget 2020 saying that if you want to claim deduction under section 35D for preliminary expense, you have to submit the report of a chartered accountant when 1 month prior to the due date of filing return. For example, if the due date of filing return is 31st July, then you have to submit the CA report with respect to 35D deduction 1 month, at least 1 month prior to that. Means you have to file by 30th June. Why na? The moment you submit the CA report na, that CA report will be uploaded to the income tax website, and when you download the income tax return form to file your return, those amounts will be pre-filled. Are you understanding? Yes or no? So government wants that your deduction under section 35D na should come pre-filled in that form. So when you download the form, you need not type the amount of deduction, you need not punch the amount of deduction, automatically it will be pre-filled. From where they will pick up the data? From the report which you have submitted. Therefore, they are asking you to file the report 1 month prior to the due date of filing return. Are you understanding? So this is the budget amendment, says that books or accounts should be audited by the chartered accountant before the specified date referred to in section 44B. What is the specified date? 1 month prior to the due date of filing return. So point 6 is done. Point 7. What would be the tax treatment of preliminary expenses in case of business restructuring, like amalgamation, demerger? This is nothing but business restructuring, na? Succession, etc. First of all, deduction for preliminary expense is allowed in what manner? Is allowed in 5 equal annual installments. It is not allowed at a stretch. Amount of deduction is allowed in 5 equal annual installments. So my question is, if the company had incurred the preliminary expenses and company will get deduction in 5 installments over a period of 5 years, what if in year number 3 amalgamation takes place? What will happen in case in year number 3 amalgamation takes place? Who will get the deduction for preliminary expense? Amalgamating company will close down na. So new company will be formed na, amalgamated company. So the question is whether the amalgamated company will be eligible to claim the deduction for the remaining period. Have you understood the question? So answer is yes. The new entity would be eligible to claim deduction for the remaining period. Let me take an example to make you understand. For example, I am taking the example of amalgamation. You can also have an example of demerger, but I am taking the example of amalgamation. There is one company, Bata Limited. They have incurred an expenditure of say 20 lakhs. They have incurred an expenditure of 20 lakhs. In which year? They have incurred this expenditure in the year 16-17. So how many years they can claim deduction? 16-17, 17-18, 18-19, 19-20, 20-21, correct? So deduction, for example, that 5% of cost of project or 5% of capital employed, listen to me carefully. That 5% of cost of project, 5% of capital employed amount is more than 20 lakhs. In that case, 20 lakhs would be selected as a lower amount, na? And this 20 lakhs will be allowed as deduction equally over a period of 5 years. So every year they would get a deduction of 4 lakhs. Yes or no? Let's say there is one more company, Tata Limited. They have incurred a preliminary expense of how much? 40 lakhs. But they have incurred this preliminary expense in the year 18-19. And in their case also, that 5% of capital employed, 5% of cost of project, that amount is more than 40 lakhs. So in their case also 40 lakhs would be eligible for deduction. This 40 lakhs will be allowed as deduction equally over a period of 5 years starting from 18-19. So 8 lakhs every year, correct? Now, for example, amalgamation took place in the year 1920. Amalgamation took place In which year? 1920. So what will happen in such a situation is Bata Limited, they are going to get deduction starting from which year? 1617. So 1617 they would claim deduction to what extent? 4 lakhs. 1718 they would claim deduction of 4 lakhs. 1819 they would claim deduction for 4 lakhs. Correct? Tata Limited would claim deduction of how much? 8 lakhs. In which year? 1819. Now 1920 amalgamation has taken place. 1920 Bata Limited, Tata Limited both are closed down. A new company has come. So 1920 what will happen? Will the amalgamated company claim the deduction on behalf of amalgamating company? Will that be allowed? Answer is yes. For the balance period. So in case of Bata, what is the balance period? 2 years. In case of Tata, what is the balance period? 4 years. So if you talk about the year 1920, Bata will get deduction on behalf of Bata. How much? 4 lakhs. Yes or no? Four lakhs plus on behalf of Tata also they will get deduction, na? 8 lakhs. So total 12 lakhs. Understood? What will be the situation of 2021? Same. 4 lakhs plus 8 lakhs. That is 12 lakhs. What about 21-22? (21-22) 5 years are over in respect of Bata, na? So this will be 0, will be only 8 lakhs. Sorry. One more year, na? One more year. Yes or no? 22-23. Have you understood this? Now, if at all you have already applied your mind, then you would have analyzed that section 32 depreciation in the year of amalgamation, depreciation was calculated as if there is no amalgamation. Yesterday we saw na section 32 depreciation. Depreciation in case of amalgamation, demerger, succession, we understood na. In that case, if there is a amalgamation, we divide the assets into two parts, common asset and uncommon asset. Common asset we calculate depreciation as if the amalgamation has not taken place. Thereafter, the amount of depreciation which is arrived is bifurcated between the old entity and the new entity in the ratio of number of days. Such kind of apportionment is not applicable in case of section 35D preliminary expense. So in the year of amalgamation 1920, deduction under section 35D is not bifurcated between the old entity and the new entity in the ratio of number of days. Are you understanding? Here, and for the entire year, that is the year of amalgamation, deduction will be allowed for the entire year to the new entity. That is the reason for the year 1920, amalgamated company took the deduction. Have you understood? So the treatment for depreciation is different and treatment for premium expenditure is different in case of amalgamation. Is that very clear? With this, section 35D is over. So we have very small section, small question on this. Section 35D, very small question. You should not take more than 5 minutes time to solve this. Y Limited is incorporated in Bangalore on 6th September 2020. So can I say 2021 is the year of incorporation? Yes or no? It commences production on 15th March 21. So it is incorporated in the year 2021 and has also started the production. Business is also coming in the year 2021. Following expenditure are incurred by the company before commencement of business. Expenditure on incorporation, issue of shares, etc. Do you believe this 184 is part of premium expense? Is it covered by the meaning of premium expense as given in 35D? Yes. So this would be considered as a premium expense. Point B, preparation of feasibility report, project report, and conducting market survey. The work is carried on by the taxpayer himself. Is this also eligible expenditure? Yes. Point number C says engineering services. Do you remember engineering services was also part of point number 2, fourth expenditure. Work is carried on by a concern which is not approved by CBDT. Do you believe this 260 should be taken into account? No. Because the expenditure is neither incurred by SSC directly or it is not incurred through the notified institute. Correct? Huh? So this point number C should not be taken into account. But alternatively, listen to me carefully. This is the alternative opinion of few authors and few teachers. I also agree to that opinion, saying that this engineering services, if at all they are incurred in connection with installation of plant, etc., then if you can't claim deduction here, don't worry about that. You go and capitalize along with the cost of the machine and you claim depreciation. Understood? But that is applicable only for engineering services, not for all expenses. So this engineering services, if it is taken in connection with the installation of plant, etc., if it is not eligible for deduction here in section 35D, then it can be added to the cost of plant and depreciation can be claimed. So what is the total expenditure incurred? 4 lakh? 4,64,000 is my actual expenditure. They are asking you determine the amount of deduction under section 35D. Assuming following figures of fixed asset and capital on 31st March 21. What is 31st March 21? Last day of the year in which the taxpayer starts production. Year of commencement of business. Now tell me, what is the cost of project? Cost of project is nothing but cost of fixed asset. That is nothing but 110 lakhs. What would be 5% of this 110 lakhs? 5.5 lakhs. Yes or no? Then second point is 5% of capital employed. Capital employed means what? Issued capital plus debentures plus long-term borrowings. Reserves is not considered as part of, are you understanding? Reserves is not considered as part of capital employed here for section 35. So share capital you take 80 lakhs, debentures 24 lakhs, long-term borrowing 16 lakhs, total would be 120 lakhs. Of that 120 lakhs, you take 5%, that would be 6 lakhs. Now I would be selecting higher of 5.5 lakhs and 6 lakhs, that is 6 lakhs. Then out of 6 lakhs and 464, I need to select whichever is lower. So what is eligible for deduction? 464. Deduction will be allowed in 5 equal annual installments. So 464 divided by 5, 92,800 is the amount of deduction under section 35D. Yes, have you understood? So with this, question number 9 is also over. I have not done the chapter of income from salaries with you. So you may or may not be aware about one point. Have you heard something called as voluntary retirement? Sometimes in case of government jobs also, people would retire before they attain the age of 80 years. Saying that no, 55 years, it is enough. I want to retire. The retirement age in case of government jobs is 58. But say for example, some individual wants to take retirement at the age of 55 years also, he can take willingly. In that case, he may be given VRS compensation. So, this VRS compensation, hey, do you understand VRS na? This VRS compensation is an income for the employee. If I am an employee, if I take VRS and if I retire willingly, I will get a compensation. That VRS compensation is an income for me. But that same VRS compensation is an expenditure for the employer. It will be an expenditure for the employer. Definitely that employer would like to debit his profit and loss account, and while computing income under that PGBP in income tax, he would like to claim deduction. But VRS compensation is a very big amount, heavy amount. If we allow deduction right away in the first year for the entire amount, then your profit will fall drastically. Government's tax collection will be affected. Therefore, government inserted section 35 DDA, wherein they say that VRS compensation, if you are paid to your employees, that amount will be allowed as deduction in 5 equal annual installments. Have you understood this? Now listen to me very carefully. This is allowed as deduction in how many installments? 5 equal annual installments. But deduction would start from which year? This deduction would start from the year in which payment is made. Not accrual basis, not payment basis also. See, accrual basis means deduction will be allowed entirely in the year in which you debit the profit and loss account. Payment means deduction would be allowed entirely in the year in which money is given to the employee. But here, deduction will not be allowed for the entire amount. It will be allowed in 5 installments. So, 5 years would start from which year? From the year of payment. From the year of payment, you will get deduction in 5 installments. For example, see, practically, listen to me carefully. Practically, the VRS compensation is a very big amount. So, if employer pays such a heavy amount to a lot of employees on VRS, then his bank balance may drastically fall down. His working capital cycle may get disturbed. So, in such cases, in practical life, sometimes the employer, instead of paying entire VRS compensation at one stretch, he can say that I will pay you VRS in 2 installments or maybe 3 installments. For example, employer has paid VRS to the employee in 3 installments. Say for example, 10 employees have accepted VRS. How many employees? 10 employees have accepted VRS. Every employee is going to get an amount of 60 lakhs on VRS. Every employee is going to get an amount of 60 lakhs. So for 10 employees, employer has to pay 6 crores. But he doesn't have that much amount of funds. So what he says, I'll pay these 6 crores in 3 installments. Yearly, every year I'll pay 2 crores. Every year I'll pay 2 crores. So 2 crores he has paid in, say for example, year 1. 2 crores he has paid in year 2. And remaining 2 crores he has paid in year 3. Now the question is, how the deduction would be allowed? Deduction is allowed in 5 installment means what? Will it be 6 crores divided by 5, that is 1.2 crores every year? No. Deduction will be on payment basis and will begin with the year in which the payment is made. So, year number 1, You had incurred how much? 2 crores. That will be divided by 5. So you get the amount of 40 lakhs. Correct? So year number 1, your deduction will be 40 lakhs. Okay, this this is first installment, na? Year number 2, you paid more 2 crores, na? More 2 crores. You paid 2 crores, na? Year number 2 also. So that 2 crores will be allowed as deduction. So that is the second payment. Deduction of first payment will continue in year number 2 as well. So this 40 lakhs will be continued. Are you understanding? You want me to make a table and explain? You understanding? Na? Or if you want me to, first installment, second installment, third installment, and total. Year number 1, 2, 3, 4, 5, 6, 7. In year number 1, how much amount you have paid? 2 crores. That will be allowed as deduction over period of 5 years starting from year number 1. So every year how much? 40 lakhs, 40 lakhs. So for the first installment, you will get deduction for 5 years. And that will be 40 lakhs every year up to year number 5. Yes or no? Year 6, year 7, no. No, 5 years are over. Second installment which you paid in year number 2, na? Once again you will get how much? 40 lakhs starting from year number 2. So year number 2, 3, 4, 5 and 6. Are you understanding? Third installment you paid in which year? Third year. So you start getting deduction from year number 3, 40 lakhs for how many years? 5 years. Yes or no? So year number 1, what will be the amount of deduction? 40 lakhs. Year number 2, 80 lakhs. Year number 3, 120 lakhs. Year number 4, 120 lakhs. Year number 5, 120 lakhs. Year number 6, 80 lakhs. Year number 7, 40 lakhs. Have you understood this? So deduction will start from the year of payment, and deduction will be allowed in 5 equal annual installments. Which section this is? Section 35 DDA. Deduction with respect to compensation paid under the voluntary retirement scheme. Yes, is that very clear? See, this is as good as we have solved one practical question. So if you come across a practical question, you should be in a position to solve. I don't have a specific question on this in the notes, but I have explained you by taking the numbers. So if at all you get the question, you should be in a position to solve it. So let us quickly refer to this. Section 35 DDA. Amortization of expenditure incurred under voluntary retirement scheme. Eligible SSC. Everyone is eligible SSC. This deduction is available to all SSC, irrespective of whether the SSC is individual, HUF, company, firm, etc. Nature of expenditure. What is nature of expenditure? Sum paid to employee in connection with voluntary retirement. Period of deduction. Deduction will be allowed in 5 equal annual installments. Manner of claiming deduction. I explained you na manner of claiming deduction by taking the example. I explained to you that deduction will be allowed from the year of payment. No double deduction means if you are claiming deduction under this section for the same amount, you cannot get into any other section like section 37(1) and claim deduction. So double deduction will not be allowed. You have to get your books of accounts audited and you have to submit the audit report. Point number 7. Consequence in case of amalgamation or demerger. A last section 35D I explained you. In case of amalgamation, deduction will be allowed to the new entity, amalgamated entity for the balance period. And in the year of amalgamation, deduction will be allowed to the amalgamated company for the entire year. The amount of deduction will not be bifurcated between the old entity and the new entity in the ratio of number of ways. The way it is being bifurcated in case of depreciation. That is not going to happen in section 35D. That is also not going to happen in section 35DDA. Now read what it says. In case of amalgamation or demerger before the expiry of specified period of 5 years, deduction shall continue to be available to the amalgamated company or the resultant company from the year of amalgamation or demerger as if the amalgamation or the demerger has not taken place. Means same meaning, same as section 35D. Deduction will be allowed to the amalgamated company for the balance number of years, that is the unexpired period. So deduction in the year of amalgamation will not be bifurcated in the ratio of number of days. Ratio of number of days is there only for depreciation. Is that very clear? Consequences of business reorganization. Similar are the provisions in case of business reorganization. Point number 7 is focusing only on two things, amalgamation and demerger. It is covering only two things. What if partnership firm has got converted into company, or other way around, company has got converted into LLP, etc. That is called as succession. The manner of deduction would remain the same. Deduction would be allowed to the new entity for the unexpired period. So similar are the provisions in case of business organization where the firm or a proprietary concern is succeeded by a company or a... Are you understood? Do you want me to read or you understood? Very good. Unlisted public company is succeeded by LLP means the company has got converted to LLP, that is called as succession. And if that succession fulfills the condition of section 47, then deduction shall continue to be available to the successor company or LLP from the year of conversion for the balance period. Actually, point number 7, point number 8, we can merge. It is the same thing. So with this, section 35 DDA is over. Do recollect that sections pertaining to the category allowed deduction, starting from section 30, ending at section 38, most of the sections are over. Now we are left with one section 35AD, which I kept as pending today, will be covering up tomorrow, and what is left is section 36. So 36 is the last section. 36 subsection 1, we are having lot of clauses. Once we complete this section 36 now, then we can say that all the sections relating to expenditure for which deduction is allowed, those sections will get over, except section 35 AD, which we are going to cover up tomorrow. In section 36, we are having broadly 15 points, but every point is a very small point. So section 36 subsection 1, section 36 subsection 1 and section 37 subsection 1 are different. Section 37 subsection 1 is a general deduction. Actually, it doesn't give you the expense, it gives you the conditions. Whereas section 36 subsection 1 is other deduction. Other deduction means those which are not covered by section 30 to section 35. But the list of other deduction is given in the section itself. So we are moving on to which deductions? Other deduction. What is the section number? Section 36 subsection 1. Here broadly we are having 15 points. Actually, section is bigger than this. Intermediate level, 15 points are enough. And these points are too small to refer. Very less, nothing to explain in most of the points. Only 3-4 points I need to discuss in detail. Otherwise, it is just reading of points. Now, before I actually forget, section 35 AD is not today's homework. It is yesterday's homework. So before I forget something, let me give you the homework for today. There is one page, I don't remember the page number. Page number 145. Page number 145. See, just looking at this, having a first glance at this diagram, you may feel that you are a physics student. But this I am giving you as homework today. Listen to me carefully. Whatever income tax you have learned till now, you might have experienced that for understanding one single section, it requires huge application of mind. And the next lecture, means tomorrow, magic is going to happen. You are going to understand 9 sections simultaneously. 9 sections simultaneously. So, this diagram, it is not consisting one section. It is a combination of 9 different sections which are there at different places in the Income Tax Act. But all of them are connected. If you just refer to the book one section at a time, you will not understand anything. So, I have accumulated all the sections in one page and I have summarized in the form of a flowchart. So, this we are going to discuss tomorrow. If you want to, I am just giving an idea what it is. Oh, sorry, I did not do the chapter of income from salary. So, what I will do this I will not discuss tomorrow. I am just giving you as homework. Maximum I can tell one sentence for each one of these sections. There are basically, the list of section is also given here. Section 2 clause 24, section 36 subsection 1 clause 4, clause 4a, clause 5, clause 5a, 40a subclause 4, 40a 9, 43b. These many sections are covered in this small diagram. See, generally, listen to me. Generally, we would take up the salary chapter after the IFHP chapter. But since you wanted me to start the PGBP chapter in the live session, face to face, I have started the PGBP chapter. So, when we move on to the chapter of PGBP, by that time we would have already completed salary chapter. There is something called as retirement benefits. In the salary chapter, you have retirement benefits like statutory provident fund, recognized provident fund, unrecognized provident fund, approved superannuation fund, etc. All these retirement funds, treatment of these retirement funds is discussed in the chapter of salaries as well as it is covered in the chapter of PGBP. Difference is, in the chapter of salary, treatment, in the chapter of salary, these things will be discussed from the point of view of employee. These things will be discussed in the chapter of salary from the point of view of employee. Same things are discussed here in the chapter of PGP from the point of view of employer. So, it is altogether different thinking. So, generally, when we reach PGBP, salary chapter is over, and in that salary chapter, retirement benefit tax treatment you might have understood from the point of view of employee. So, it is easier for me to refer same retirement benefits from the point of view of employer. So, what I will do, this diagram will not cover up right now. We will cover up all the sections in one line. But you should not ask me a lot of questions on those points. And then once we move on to the chapter of income from salary, and when we complete the chapter of salary, once again we'll come back here on this page and we'll cover up the entire exhaustive discussion of these 9 points. But right now these 9 points will be covered in one sentence. So right now I move on to which section? Section 36, subsection 1. Point number 1, 2, 3, 4 will get completed in maximum 5 minutes. So even for a moment you look here and there, you will meet after one section only. Section 36, subsection 1, clause 1. Section 36, subsection 1, clause 1. Deduction is allowed for insurance premium. Insurance premium for what? Damage or destruction of stock or stores. See, in your godown, in your warehouse, you might be having stock of raw material, you might be having stock of WIP, you might be having stock of finished goods. If you take the insurance for this, you are going to pay the insurance premium. That insurance premium will be allowed to as deduction in section 36, subsection 1, clause 1. Have you understood this? Section 36, clause, subsection 1, clause 1 is over. Are you aware about this? Just 1 minute back I told you, 5 minutes, now 4 sections will get over. So if you don't focus, we'll meet after 5 sections only. Listen to me very carefully. I am giving you a very important point. Very, very important point. Or if you want, instead of giving that point or instead of explaining that point, I will ask you a question. And then you will give the wrong answer. And then I will tell that this is wrong. What is the correct thing? What it says, section 36, subsection 1, clause 1 says what now? Any insurance premium paid in respect of insurance against risk of damage or destruction of stock or stores which are used for the purpose of business profession. This is allowed as deduction. Referring to this point, my question to you is, deduction is allowed on which basis? Accrual basis or payment basis? Means payment basis, no? So your understanding is totally incorrect. The word paid, the word paid which is written here should not be construed as word payment. The word paid is also defined in the Income Tax Act in PGBP chapter. What is the meaning of the word paid? This word paid indicates deduction will be allowed based on the method of accounting followed by SSE. In other words, if SSE is following mercantile system, deduction will be allowed on accrual basis. If SSE is following cash system, deduction will be allowed on payment basis. In other words, the word paid does not mean payment. It denotes that deduction will be allowed based on the method of accounting followed by SSE. Have you understood this? Now see, this word paid is appearing in mostly in each and every point. Word paid will appear. Refer to this next point. See, point number 2 word paid is appearing. Point number 3 also word paid is appearing. Actually in point number 5 also it is appearing, but I have simplified all these points. So what is the meaning of word paid here? Deduction is allowed based on what? Based on method of accounting followed by SSE. If SSE is following mercantile system, deduction will be allowed on accrual basis. If SSE is following cash system, deduction will be allowed on payment basis. Now, before I actually move on to some other point, Let me give you a reference, just a reference. I am not discussing the section in detail. I am just giving a passing reference. In the chapter of house property, deduction for municipal tax was allowed on which basis? Payment basis. Similarly, when we move on to the chapter of income from salaries, you will realize that there is one deduction which is allowed on payment basis, and that is deduction with respect to profession tax. So, in the chapter of income from salary, there is one tax called as profession tax. Deduction for that profession tax will be allowed on payment basis. So, every head of income, there are certain deductions which are available only on actual payment. So, the question arises, do we have any expenditure or list of expenditure for which deduction is allowed under the head PGBP on actual payment basis? Answer is yes. And list of such expenses for which deduction is allowed on payment basis is given in section 43B, 43B. So, in the chapter of PGBP, all expenditure deduction is allowed based on the method of accounting followed by SSE. If SSE is following mercantile system, deduction for expenditure will be allowed on accrual basis. If SSE is following cash system, deduction for expense will be allowed on payment basis. Now, just now I told you that in the chapter of PGBP, we have one section. Which section? Section 43B, which gives you the list of expenditure for which deduction will be allowed on payment basis. Now, my question to you is, based on whatever I have explained to till now, my question is, this section 43B is made for which SSEs? All SSEs? Or only those SSEs who are following mercantile system? Or those SSEs who are following cash system? Section 43B says what? There is the list of certain expense. For that expenses, deduction will be allowed on payment basis. And you think about an SSE following cash system accounting. To him, deduction for all the expenses allowed on payment basis only. Yes or no? See, listen to me. If SSE is following cash system accounting, income is taxable on receipt basis, deduction for expenses available on payment basis. In other words, if SSE is following cash system accounting, all expenditure deduction is allowed on payment basis only. Meaning thereby, there was no need for the government to make a separate section just to say that deduction will be allowed for certain expenses on payment basis. Because in case of SSE following cash system, anyway deduction was allowed on payment basis only. Are you understanding? So once again I am asking the same question. According to your understanding, section 43B is made for which SSE? Who are following mercantile system or who are following cash system or both? Those who are following mercantile system. Because those who are following cash system, to them anyway deduction is allowed on payment basis only na. So there is no need to make a separate section. Yes or no? So before I move on to the next clause in section 36 subsection 1, I wanted to tell you that in the chapter of PGBP, we have one section, section 43B, which gives you the list of expense for which deduction will be allowed on payment basis. In other words, this word paid indicates that deduction will be allowed based on the method of accounting followed by SSE. If government wants that certain expenses out of this deduction will be allowed on payment basis, if government wanted, listen to me, If government wants that certain expenses out of this list, na payment deduction should be allowed on payment basis, then government will give you the reference of section 43B inside this section. Are you understanding? Oh, yes or no? So if government, for example, see, point number 1 is over. Point number 4. Point number 4 says what? Bonus or commission paid to employees for services rendered. Deduction will be allowed where such sum would not have become payable as profits or dividend. Forget about this point right now. Bonus or commission paid to employee for services rendered will be allowed as deduction. In the bracket they have written subject to 43B. Subject to 43B means what? Deduction is allowed on payment basis. See, if the meaning of this word paid, itself is payment, then there was no need to give reference to 43B. Are you understanding? This word paid which is appearing here in this sentence, if the meaning of this word paid was required to be considered as actual payment, then there was no need to give a reference to 43B. I am explaining you the reason. The word paid indicates what? Deduction will be allowed based on the method of accounting followed by assessing. So I am explaining the reason why this word paid should not be interpreted as payment. Because in further sections, government has given the reference to section 43B, meaning thereby whenever government wants to give you deduction on a payment basis, they have given the reference to which section? 43B. Why there is a need to give reference to 43B? Because the meaning of this word paid is not payment. Have you understood? If the meaning of this word payment, the word paid, if it would have been interpreted as actual payment, then there was no need to give any reference to section 43B. Have you understood? So we have completed point number 1. Point number 4 is also completed. Point number 4 says bonus or commission paid to employees will be allowed as deduction. What do you mean by paid? Based on method of accounting followed by SSE. If SSE is following cash system anyway, payment basis. If SSE is following mercantile system, then also payment basis, because section is giving reference to 43B. Is that very clear? Point number 2, section 36, subsection 1, clause 1A, insurance premium. This insurance premium is paid by whom? Federal Milk Cooperative Society. On what? On the life of cattle. Cattle owned by whom? Cattle owned by member of Primary Milk Cooperative Society affiliated to such a Federal Milk Cooperative Society. See, listen to me carefully. Generally, deduction for the expenditure will be allowed provided it is incurred for your business. See, if deduction is allowed for deduction is incurred for his business. If I incur deduction, if I incur expenditure for his business, can I claim deduction? No. I will claim deduction for the expenditure only if expenditure is incurred for my business. Why government will give me deduction for expenditure incurred on his business? If the expenditure is incurred by him for his business, he can claim deduction. If expenditure is incurred by me for my business, I can claim deduction. But if I incur expenditure for his business, then I should not get deduction. Correct? But in this point, I am incurring expenditure for his benefit. Still government is giving me deduction. Generally, deduction is not allowed if you incur expenditure for someone else. If you incur expenditure for your own business, then only deduction is allowed. But in this point, deduction is allowed even if you are incurring expenditure for some other person. We have read the point. I am sure you might not have understood. So I am giving you an example. For example, there is one small village. There is one small village. In that village, only 5 families are residing. In that small village, only 5 families are residing. Manoj's family, Ishwar's family, Harshit's family. What is his name? Sarvana Hotel, you are the owner? What is your name? This one. Now, only 5 families are staying in that village. Each of the individuals, they are owning 5 cattle, 5 cows they are owning, or 5 buffaloes they are owning. So Manoj is a very rich person, 10 cows. Ishwar is owning 8 cows. Harshit, poor person, 6 cows. Sarvana, 4 cows, 2 cows. Now, for example, every cow gives say 4 liters of milk a day. One cow gives 4 liters of milk a day. So Sarvana will be getting how much? 16 liters of milk. So he stays in some remote part of the state, in very small village. He decides that I will take this milk and I will go to the city in Chennai. I will sell the milk, because in village the price of the milk is only 15 rupees per liter. But if I sell the same milk in Chennai, I will get at least 50 rupees. 50 rupees a liter, very easily you can sell it. So he decides that I will take that 16 liters of milk, I will go to Chennai, I will sell it, I will come back. From his village, if he wants to come to Chennai, it takes 36 hours. Is it possible for him to come on a daily basis to sell the milk? No. Milk is a perishable commodity. So within a span of 7-8 hours, it will be perished. He do not have that much amount of money that he would buy a refrigerator. Small refrigerator also he cannot buy. He doesn't have that much amount of money. So a very big investor would come. Say for example, Amul. Amul is a very big investor. Here you have a company called as, his company. We have one more company, Hudson Agro, Hudson. Hudson Agro is a listed company, stock exchange, it is listed. So it's a very big company. So for example, this Amul, you are aware about Amul? So it is a Gujarat based company. Now this Amul will have a lot of funds. So what they will do now? They will develop a infrastructure for doing the milk business. So they will have cold storage tankers, they will have the factory premises, they might have installed the plant, they will filter the milk if there is some, say, scrap or something like sand or something fallen in the milk, they will remove that, they will filter, basically filtering will be done. Whatever it is, you are more aware, I am not into this business. So what will happen now? All these activities cannot be done by the small people, because huge amount of investment is required, lot of plant and machinery is required to be purchased. So entire village, all the people residing in the village, they will form a cooperative society. And Manoj is appointed as the chairman of the cooperative society. This cooperative society is called as Primary Milk Cooperative Society. This cooperative society is called as Primary Milk Cooperative Society. So Primary Milk Cooperative Society is nothing but a group of individuals. In this group now there are 5 individuals, there are 5 members. Each of the member is owning a cattle. Now, near to the Manoj's house, Amul has given him a tanker, steel tanker. So, everyone will come to near to the Manoj's house and he will submit the milk. So, every day he will give 16 liters of milk he will put in that tanker, and Manoj will keep record that today I have received milk from so and so persons, this much amount of quantity. And the Amul tanker will come to the Manoj's house, and Amul tanker will collect entire say 250 liters of milk. And Amul will take that milk to their own factory, they will do the processing, they will do the packing, and then they will ensure that this milk is sold in different part of the country at a good price. Whatever price they realize, whatever money they realize, out of that major amount will be given to the members of a primary milk cooperative society. So Amul is basically taking milk from primary milk cooperative society. And who is giving milk to primary PMCS? Members of the society. Now, who is owning the cattle? Member is owning the cattle. Member is owning the cattle. Say for example, Manoj is owning the cattle. So someone went to Manoj, an insurance company went to Manoj saying that, Manoj, you are having 10 cows na, you take the insurance for cow. If cow dies na, your business is going to get affected. So you should take the insurance. Manoj says, insurance for cow? I don't have insurance for myself. How would I take the insurance for cow? So he is not ready to pay the insurance premium. He said that I cannot afford paying the premium. Even if my risk will be covered now, I am not in a position to pay the premium. I cannot afford. So, but if something happens to the cattle of the member, now business of Amul is also going to get affected. Therefore, what Amul does, Amul will take the insurance, life insurance on the life of a cattle owned by the member of primary milk cooperative society. This cattle is not owned by Amul. This cattle is owned by member of primary milk cooperative society. So Amul will incur the premium. Amul will pay the insurance premium to insurance company. Insurance company, Amul is paying premium. Premium on what? On the life of cattle. This cattle is owned by whom? Member of primary milk cooperative society. So this cattle is not owned by Amul. See, if asset belongs to Amul, and if insurance premium is paid by Amul for their own asset, then definitely they can claim deduction. But here they are paying premium on a cattle which is not owned by them. It is owned by member of PMCS. Therefore, generally deduction should not be allowed. Correct? Huh? But indirectly, if something happens to the cattle, if the cattle dies, in that case, Amul's business will also get affected. Therefore, for allowing deduction in this situation, government has come out with a separate clause in section 36 subsection 1 which gives deduction to Amul. Correct? So, read it once again. Insurance premium paid by whom? Paid by Federal Milk Cooperative Society. On what? On the life of cattle owned by whom? Member of Primary Milk Cooperative Society affiliated to it. So member is affiliated to PMCS, PMCS is affiliated to FMCS. So Amul is FMCS, Federal Milk Cooperative Society. Point number 6 is very small. Insurance premium paid by SSC as an employer. Insurance premium is paid by SSC as an employer on what? On the health of his employees. So employer has taken the health insurance policy for employees and he is paying premium to the insurance company, that premium will be allowed as deduction provided payment of that premium is made by any mode other than cash. Any mode other than cash. So if you make the payment by cross check, will deduction be allowed? Yes, because it is using the word any mode other than cash. Now listen to me, listen to me. Listen to me. This section is a specific provision. So if you want to claim deduction for insurance premium paid on the health of employees, you can't go to any other section. You have to come in this section only, and this section says deduction will be allowed if the payment is made by any mode other than cash. So other than cash means by cross check also it is allowed. Is that very clear? But we are going to discuss one more section, 40 capital A3, which says that cross check payments will not be allowed as section. But there is a separate section. Definitely that section says all the expenditure which are covered by section 30 to 37, na, 40A3 will apply. But I say that in the section 36 subsection 1 clause B itself, they are using the word other than cash. So cross check should be allowed in this case. Specific rule will prevail over the general rule. Section 36 subsection 1 clause B is over. Now can you tell me what is the difference between clause 1A and clause 1B? Clause 1 is insurance for cattle and clause 1B is insurance for employees. What is one more difference? Oh, paid by other, this is paid for own employees. What is one more difference then? No, that one, second one was life insurance, this is health insurance. Life of cattle and health of a human being. So 4 points are over. Fifth point, section 36 subsection 1 clause 3. Section 36 subsection 1 clause 3, interest on loan borrowed for the purpose of business or profession. First of all, there is a definition of word interest in the Income Tax Act. The definition is given in section 2 clause 28A. It says interest is defined to include any service fees or any other charge in respect of money borrowed or debt incurred. For example, you recollect in the chapter of house property, I told you that fees or commission or brokerage paid for arranging the loan cannot be claimed as deduction because it is not interest. But here, that brokerage fees, or if you take a loan from bank, now you will have to pay processing fees. That processing fees is also considered as interest because the section which defines the word interest uses the word, it includes any service fees or any other charge. So this word any other charge is very wider in scope. So if you pay brokerage for arranging the loan, that can also be taken into the purview of the word any other charge. That will also be considered as interest and that will also be allowed as deduction. So point 1 is definition of interest. So you might have understood that the word interest doesn't only include interest, it also includes other charges etc. or service charges in connection with raising the funds or taking the loan. Second point, it is implied or profession. If they are not utilized for the purpose of business profession, Yes. Have we covered this point earlier? Yes, in explanation to section 43(1), explanation 8, same thing is reproduced here. What it says? Interest cost from the date of loan till the date of commencement of commercial production should be added to the cost of an asset. It should be capitalized. It cannot be claimed as deduction. So this is already covered. Point 4. Deduction not allowed for interest on own capital. In income tax, proprietor and business of proprietor are not considered as two different entities, because in income tax we don't have concept of entity. So if it is a, listen to me here, if in the examination examiner gives you a question which pertains to the business of a sole proprietor, it pertains to business of sole proprietor, then interest on capital, rent paid to the proprietor, salary paid to the proprietor, all these things will not be allowed as deduction, because the payer and payee both are same. I cannot pay salary to myself. I can't say that my business has paid salary to me, because in income tax we don't have a concept of entity. So my business and me both are one and the same. So any interest which is paid by the business to the proprietor on the capital will not be allowed as deduction, because it is just a book entry. So deduction will not be allowed. No deduction for notional interest. Only actual interest will be allowed as deduction. Point 6. What is the criteria for allowing deduction with respect to interest on loan? What is the criteria for allowing deduction with respect to interest on loan? For that I have made a flowchart here. Interest on capital borrowed for the purpose of business or profession will be allowed as deduction. On what basis? Will it be allowed on accrual basis? Will it be allowed on payment basis? That is what we need to understand here. I have already told you that all the expenditure deduction will be allowed based on the method of accounting followed by SSE. If government wants to give you deduction on payment basis, then government is going to give you a reference of which section? Section 43B. So now we are dividing the loan in two parts, or we are dividing the loan into two categories based on from whom you have taken the loan. Possibility number 1, you have taken loan from any public financial institution. You have taken loan from state financial corporation, state industrial investment corporation, or a scheduled bank. Basically, you have taken loan either from a bank or financial institution. In that case, interest on loan is allowed as deduction under section 36, subsection 1, clause 3, subject to 43B. What do you mean by subject to 43B? Payment basis. See, SSE following cash system accounting, he is going to get deduction for all the expenses on payment basis only. So section 43B is not made for those who are following cash system. Section 43B is made for only those SSEs who are following mercantile system of accounting. Is that very clear? So if you have taken loan from bank or financial institution, deduction for interest on loan will be allowed subject to 43B, means it will be allowed on payment basis. If SSE is following cash system, anyway it will be allowed on payment basis only. Is that very clear? But if the loan is taken from any other person, what is by any other person other than bank or financial institution? If you have taken loan from your friend, from a relative, or from local Marwadi, they are into unorganized sector, now they provide funds at a very high rate of interest. So if you have taken loan from them, unorganized sector, still you can claim deduction. but that deduction will be allowed based on the method of accounting followed by SSE. If SSE is following mercantile system, deduction will be allowed on accrual basis. If SSE is following cash system, deduction will be allowed on payment. So, one line conclusion is, if you have taken loan either from bank or financial institution, deduction will be allowed subject to 43B, that is payment basis. Is that very, very clear? So, point number 5 is over. Not right now, yeah. Can I have a break at 12 o'clock? 11:40 it is. We started at what time? 9:40. So still you can manage 20 minutes, I think. You can't. Do one thing, we'll discuss one point and one question. One point number 6. Point number 6, very small it is. Only 6 lines. So we'll discuss this point. Based on this only, we have one practical question. And then we'll have a break. Section 36, subsection 1, clause 3A. Every 1 hour there should be a break of 5 minutes, and you should not be allowed to move outside the classroom. During those 5 minutes, you should be forced to get up on your seats and do the exercise. Stretch your body. Because morning when you that is the situation. You sleep for how many hours? 3 hours. You should be given the position of a prime minister then. When 3 hours he is sleeping, he is working. It means he is working for 21 hours a day. So he can definitely manage 5 hours. Do you feel it is sufficient for you? No. What to do? Sleep for 6 hours. 7. Anything beyond 7 hours, na? If you sleep beyond 7 hours, at your age, sleep of 7 hours is optimum sleep. 6 to 7 hours. 7 is the optimum sleep. If you sleep 10 hours, then you come in this world only to sleep. And if you sleep 10 hours throughout your life, and for example, when you die and leave this world, and if God sees the video of your life, if you stayed in this world for 60 years, every day out of 25 hours, 24 hours, you slept for 10 hours, so it is around. So out of 40 years of your age, you slept for 24 years. 24 years. So if you bifurcate your life now, 60 years, 24 years is next lecture anyway it is online, yeah. हाँ, page number 134, question number 10. See what it says. 5th January 2021. Listen to me carefully. I have not intentionally, I have not explained one point to you. Till now, I have not explained one point. Actually, it is not part of section, it is part of income tax rules. I am not explaining you that. I will explain right now when I read the question. 5th January 21, X Limited issued 1 lakh zero coupon bonds of the face value of 100 each at 40 each. So what is the discount? 60%. 60 rupees per bond is a discount. 1 lakh bonds are issued. So the total discount is 60 lakhs. These bonds are redeemable at par, means at 100. On which date? 4th January 2026, means exactly after 5 years. These bonds are notified by the government as zero coupon bonds. Compute the amount of deduction available under section 36 subsection 1 clause 3a for various assessment years. Deduction will be allowed over the tenure of the bond. Now, please don't calculate, you will get the wrong answer. Deduction will be allowed equally over the tenure of the bond. The tenure of the bond will not start on 1st April. Tenure of the bond starts on 5th January. So, what you have to do now? The month in which the bonds are issued, that is which month? January 21. January 21 bonds are issued on 5th January. So, if you count the days from 5th January to 31st January, how many days? 27 days. So, this turns out to be more than 15 days. Correct na? More than 15 days na? It should be taken as full month. It should be taken as full month. Have you understood this? One more point. Listen to me. See, everything is written in the book. I will show where it is written. Listen to me just. When these bonds are going to get redeemed? 4th January. So, January 2026. January 2026. How many days? 4 days only na? Date of redemption 4 January 26. So, January 2026 only 4 days. Less than 15 days na? That month should be totally ignored. That month should be totally ignored. So 15 days or more, if you get 15 days or more in a particular month, that should be considered as full month. Less than 15 days, that month should be totally ignored. Now you tell me, bonds are issued on in which month? January 21. Now January 21, you are having more than 15 days. So January 21 will be considered as the entire month. So in the financial year 2021, how many months of bonds were issued? 3 months, na? January, February, March. So discount proportionate to 3 months would be allowed as deduction in the financial year 2021. Financial year 2021. First of all, bonds are issued in the month of January 21, means they are issued during the financial year 2021. Bonds are issued in the month of January 21. We have more than 15 days now because bonds are issued on 5th. So January 21 would be taken as entire month. So January to March, how many months? 3 months. 21-22, entire year, correct? April to March, so how many months? 12 months. 22-23, same, 12 months. 23-24, same. How many years we need to do this? 5 years. So how many years count now? Total 6 years. See, bonds are issued for a span of 5 years, but those 5 years are spread over 6 different financial years. Here it will be from which month to which month? April to December. January will be ignored because it is less than 15 days. So it will be 9 months. Now tell me, there are how many bonds? 1 lakh bonds. Discount is how much? 60 rupees per bond. So what is the total amount of discount? 60 lakhs. This 60 lakhs should be allowed as deduction spread equally over 60 months. So during the financial year 2021, we get how much deduction? 3 lakhs. then 10 lakhs, sorry 12 lakhs, 12 lakhs, 12 lakhs and last 9 lakhs. This 60 lakhs will be allowed towards deduction spread over 6 different financial years. Is that very clear? Want to copy the solution? It is already there in the book. See this. Note is also written. If part of the month is 15 days or more, it should be taken as 1 month. If it is less than 15 days, it should be ignored. Correct? So we have completed this section. Section 36, subsection 1, clause 3 is over. Do you actually need a break? Tomorrow onwards we are taking online session, na? I am just today afternoon I will be just making my schedule because I am taking lectures here also and Mumbai lectures online I am taking from here. So I am going to make schedule in such a manner that I should be in a position to take your lectures for at least 6.5 hours. Not continuously, slots, yes. So it will be first slot for income tax and then maybe for GST and once again income tax after that. So we may have sort of 3 hours, 15 minutes, 2 slots or maybe 2 hours, 3 slots. So we are on page number 130. Lastly, before the break, we completed section 36, subsection 1, clause 3A. You are still having interest to get 10 kids? Point 6, section 36, subsection 1, clause 3A, discount on 0% bond was the last point which we discussed before the break. Now, the diagram containing 9 sections, out of those 9 sections, 4 are in section 36, subsection 1 itself. So, I will explain you in one line. Once we move on to the chapter of income from salary and once we complete the chapter of income from salary, once again we will come back to PGBP to refer to that very complex diagram of 9 sections. So as of now, please don't ask me question what is provident fund, what is superannuation fund, what is gratuity fund. Don't ask me such questions. You just remember that it is a retirement fund. Provident fund, you know, 12th standard also final accounts chapter you might have referred now. Provident fund. Provident fund is nothing but the retirement fund created by the employer for the benefit of employee. In the provident fund, who will contribute money? Employer, employee, both will contribute. Yes or no? Whatever contribution employer is making is an expense for employer. Is an expense. Are you understanding? 12th standard final account chapter, you had adjustment relating to provident fund, na? In the trial balance, they used to give you provident fund investment, interest on provident fund. Do you remember? So what is that provident fund? It is nothing but a retirement fund created by employer for the benefit of employee. In that provident fund, employer, employee both will contribute certain sum of money. That amount which is contributed to the provident fund will be invested somewhere. On that interest will be earned, and then when employee retires, whatever is the balance lying in that provident fund will be given to the employee. So we have a lot of different retirement benefits. One of them is provident fund. Similar to provident fund, we also have approved superannuation fund. We also have gratuity fund. We also have pension fund. All these are different types of retirement benefits given by employer to the employee. Now, since we have not discussed the salary chapter, I am just saying you that all these retirement funds, when employer contributes money to this fund, it is an expense for employer, so he would debit his profit and loss account. He would debit his profit and loss account and he would claim deduction for it. In which section deduction will be allowed? We have separate sections. We have separate sections. Section 36 subsection 1 gives deduction for what? Employer's contribution to which fund? Recognized provident fund or approved superannuation fund. We are giving deduction to whom? This deduction is allowed to employer or it is allowed to employee? It is allowed to employer. For whose contribution? His own contribution. Yes or no? Yes or no? Point number 8. Employer's contribution to which fund? Employees pension fund. In pension fund also employer and employee both will contribute. This pension fund now we are going to discuss in very much detail when we get into the chapter of deductions from gross total income. We will be learning section 80 CCD. Section 80 CCD. At that point of time I will be discussing that pension fund in much detail. Right now we should understand that pension fund is nothing but one of the retirement benefit given by employer to the employee. And in this pension fund also, similar to provident fund, in this pension fund also employer employee both will contribute. So here we are talking about whose contribution? We are talking about employer's contribution. Employer's contribution is what for employer? It is an expense for employer. Since it is an expense, he will debit his profit and loss account and he will ask for deduction. Deduction will be allowed in this section, section 36 subsection 1 clause 4a. Have you understood this? Next, point number 9. Employer's contribution to approved gratuity fund. Till now we have referred 3 funds. Provident fund, superannuation fund, pension fund. Now this is the 4th one, gratuity fund. All are retirement funds only. In all the funds, employer will make the contribution. Whatever is employer's contribution is an expenditure for employer. He will debit his profit and loss account. Thereafter, he will claim the deduction. So, deduction for employer's contribution to approved gratuity fund will be allowed in which section? Section 36, subsection 1, clause 5. But here deduction will be allowed. See, here also they had given the reference to which section? Section 43b. Here also they are given the reference to 43b. What is the meaning of this? Deduction will be allowed on payment basis. If SSC is following cash system accounting, deduction for all expenses anyway allowed on payment basis, section 43b is applicable to only those SSCs who are following mercantile system of accounting. Is that very clear? So section 36 subsection 1 clause 4, clause 4a and clause 5 is giving deduction to employer for employer's contribution to different types of retirement funds. Is that very clear? This point number 10 is very difficult to understand at this point. Should I make an attempt to make you understand? Do you have that much amount of capacity left? Very good, superb. Now, say for example, there is an employer, there is an employee. Employee will render services to employer. In turn, employer will pay salary. But the salary which is paid by employer to employee is a net salary. Let me take an example. For example, when you received the offer letter from the employer, that is appointment letter, your appointment letter will also have financial details. Financial details means details about your salary. In that, your gross salary is 25,000 per month. If your gross salary as per your appointment letter is 25,000 per month, do you believe that at the end of the month you will be receiving 25,000 in your bank account? Not at all. Lot of things will be compulsorily deducted. Lot of things will be compulsorily deducted. For example, employer will deduct profession tax. Employer will deduct profession tax. Say for example that is 200 per month. This profession tax employer will pay to whom? To the state government. To the state government. Employer will also deduct income tax, which is also called as TDS. For example, listen to me carefully. Don't go and calculate and verify. If 25,000 is your income, na, yearly income would turn out to 3 lakhs only. 2.5 lakh is basic exemption limit. Beyond that, income would be taxable at 5%. After 87 A rebate, your tax liability would be 0. So don't ask me the question, sir, tax liability is 0. Why the income tax is deducted? I am just giving certain numbers to make you understand the concept. Don't try to cross verify my numbers. So what is deducted from your salary? Profession tax 200 is deducted, income tax 800 is deducted. Besides, listen to me very carefully. In the provident fund, who will contribute? Employer, employee, both will contribute. Provident fund is a retirement benefit where employer, employee both will contribute when the employee is doing the job. Once the employee is retired, entire amount of balance lying in the provident fund will be given to employee. Hey, November 21 soon should understand this. So, how the employee will contribute? Will he give money out of his own pocket every month saying that this is my contribution? No, his contribution will be deducted from his salary. So, employer will deduct what? Employee's contribution. Employee's contribution to provident fund. Employee's contribution to provident fund will be deducted from employee's salary only. And finally, what will be paid to employee? 22,000 per month will be paid to employee. This amount paid is called as net salary. Correct? Now my question to you is, in 11th standard, for every transaction you used to pass journal entry, na? So for this transaction, employee has rendered services, employer has paid salary. For this transaction, what journal entry you will pass? What journal entry you will pass for this transaction? So tell me the journal entry now. Professional tax debit. Okay. How much? 200. Okay. Income tax debit 800. Then you are passing entry in the books of accounts of employer, correct na? Oi, salaried employee do not maintain the books of accounts. If your father is doing job, at the end of the month when he receives salary, he is not going to make the format of the journal in the notebook at the end of every month. He is not going to pass an entry. So this discussion is from the point of view of employer. So my simple question to you is, what journal entry you are going to pass? Will you pass an entry salary account debit to bank account 25? If yes, you are still in 11th standard. CA intermediate journal entry in accounts would be salary account debit 25,000 to profession tax deducted 200, to income tax deducted 800, to employees provident fund contribution deducted 2000, to bank account 22,000. So now listen to me. This 200 per month which is deducted is what for employer? First entry. Listen. You have to apply your mind before saying anything. Once again, I am repeating journal entry for you. If this is expense, how can you credit? Expenses are always debited, na? So I am repeating journal entry for you. Journal entries: salary account debit 25,000. So this will be debited to profession tax deducted account, to income tax deducted account, to employees PF contribution account, to bank account. So this debit is definitely an expense. Then you will pass entry profit and loss account debit to salary 25. Now the question is, what is this credit 200, credit 800, credit 2000? Is it an income? Or that I understood, but is it an income? No, it is not yet paid. Is it an income? I am giving you two options. I am simplifying the job for you. You have four options. It is income, it is expense, it is asset, or it is liability. It is a credit balance, so it can't be expense, it can't be an asset. It has to be either an income or a liability. So what it is? Liability. Yes or no? So this 200 deducted is a liability. Liability towards the state government 200. Liability towards the central government 800. Liability towards the employee retirement fund 2000. Are you understanding? Now, from this only I am asking you question. In this chapter of PGBP, we are thinking from the point of view of employer. For employer, employee's contribution is what? Is it an asset, expense, income, liability? What it is? For employer, employee's contribution is what? What it is? Liability. Just now I told you. Oi, all these three are liability, huh? For employer, employee's contribution is a liability. But in Income Tax Act, listen to me carefully, please don't talk. In Income Tax Act, we have one section, section 2, clause 24. What is section 2, clause 24? Na? Definition of income. Section 2, clause 24 is definition of income. First chapter, basic concept, when we discussed, I did not discuss definition of income with you, but I told you that for charging tax on any income, you need a charging section as well as the machinery section. In those features relating to income, I discussed the point of revenue receipt and capital receipt with you, wherein I had explained you that by default, all the revenue receipts are income. In other words, for every revenue receipt, either you will have a charging section plus machinery section, or you will have exemption section. For every revenue receipt, you will have some section in the income tax. If government wants to levy tax, they will make charging section and machinery section. If they do not want to levy the tax, they want to exempt the particular income, they will make a exemption section. In other words, for every revenue receipt, there would be a section. What about the capital receipt? Capital receipts by default, they are not considered as income. They are not considered as income. If at all government is having an intention to levy tax on a particular capital receipt, can they levy the tax? Yes. For that they will have to make charging section and machinery section. But before that, what they will have to do? First of all, they will have to amend the definition of income to include that capital receipt in that income. Because capital receipt is generally not considered as income. Na? If particular thing is not an income, how can you make a charging section and machinery section and levy the tax? First of all, it has to be income. So, to make that capital receipt as income, government will amend the definition of income. And government will say income includes following capital receipts. So, if government wants to levy tax on a particular capital receipt, the first job which government is expected to do is amend the definition of income and include that capital receipt in the income. Then only they can levy the tax, and then only they will make the charging section and machinery section. Is that very clear? Now, this employees contribution, our focus is this. This part is the focus of our discussion. This employees contribution is what for employer? It is a liability for employer. But Income Tax Act says, even though it is a liability for employer, don't consider it as liability. While calculating business income of employer, you consider it as income of employer. Anything which is a liability would appear on the balance sheet liability side. If you want to consider that liability as a income, what you will do? You will add it to income. See, you are not going to change the profit and loss account. Accounts are already made, you will not touch. But while computing business income, we are going to do certain adjustment, addition and subtraction related adjustment. In that, we will add the liability. We will add the liability. So that liability will be considered as an income. That liability will be considered as income. Now see, why the liability is considered as income? Why the liability is considered as income? Because government says we have made two steps. Step number one, we will consider the liability as your income, as a result of which your income will increase. And then we will ask you to deposit this money in the fund account. The employee retirement fund will have an account number. So, employer will be asked to deposit this money which he has deducted from employee's salary. He will be asked to deposit that money in the retirement fund account. And for depositing this money in retirement fund account, there will be a due date. There will be a due date. If the amount is deposited in retirement fund before the due date or up to the due date, then that will also be allowed as deduction. That will also be allowed as deduction. So what is the net effect? Step 1, it is considered as income. Step 2, we asked you to deposit this money in the employee's retirement fund account within the due date. You have deposited and we are giving reduction in step 2. So step 1, that amount is added. Step 2, that amount is deducted. Net effect is 0. Yes or no? You understood something? But for example, I am employer, you are employee. While paying you salary, from that salary I have deducted your contribution to the provident fund. Your contribution to the provident fund is my income, is my liability. But Income Tax Act Section 2 Clause 24 definition of income says this liability should be considered as your income. In accountancy, it will not be considered as income. It will be considered as a liability. It will appear on the liability side of balance sheet only. But Income Tax Act says you consider this as income. So it will be added to my income while computing the PGBP income. So the amount which I have deducted from your salary as your own contribution, employee's contribution, is liability for me, but will be considered as income. It will be added to my income. Now government says go and deposit money in the retirement fund within the due date. If I do not deposit within the due date, then government says now step number 2, we will not allow you deduction. If I do not deposit that money within the due date, in step number 2, they will not allow me deduction. What is the consequence? that amount is added to my income but is not allowed to be deducted, as a result of which my income will increase, my tax liability will increase. So as an employer, if I deduct something from employee's salary as contribution, listen to me, as an employer, if I deduct something from employee's salary as employee's contribution, and if I don't deposit in the employee's account, government is penalizing me. How they are penalizing me? By considering that as my income and not allowing me deduction, as a result of which my net income would increase. If my net income increases, my tax liability will also increase. Have you understood? So I have explained to you that it is a two-step mechanism. It is a two-step mechanism. Step number 1, liability is considered as income, so it is added to employer's income. And step number 2, deduction is also allowed, provided amount is deposited in the retirement fund within the due date. So now the question is, step number 1, add to income. That effect, which section is applicable? Which section says that you add to income? Definition of income, section 2 clause 24. Section 2 clause 24 along with section 28. Section 2 clause 24 along with section 28 charging section. Which section says that you give deduction in step 2? Section 36 subsection 1 clause 5a. Section 36 subsection 1 clause 5a. Now what it says? Listen to me. Section 36 subsection 1 clause 5 I am referring to. Before I actually read, I am asking two questions. This side should answer. This deduction is allowed to whom? This deduction is allowed to employer or employee? Employer. Deduction is allowed for what? Deduction is allowed for employer's contribution or employee's contribution? Employee's contribution. Deduction is allowed to employer. Are you understanding? Why deduction is allowed? Why deduction is allowed? Why should we allow deduction for liability? Why should we allow deduction for liability? Deduction should be allowed for expense. Because that liability is no more a liability, that is already considered as an income. Yes or no? Oh, say yes or no. Employees' contribution towards staff welfare scheme. When an employer receives contribution from his employee towards any staff welfare scheme, it is not the income of employer, it is considered as an income of employer. It is considered as an income of employer. When employer deposits such sum to the credit of employee's account in the scheme, it is allowed as deduction in section 36 subsection 1 clause 5a. However, deduction under this section is allowed when the employer deposits the amount to the credit of employee on or before the due date of depositing such amount under that fund or scheme. And this deduction is also subject to section 43b. What do you mean by 43b? Deduction is allowed on payment basis. So with this section 36 subsection 1 clause 5a is over. I am giving you 30 seconds time. Just refer 36 subsection 1 clause 6 and tell me whether we have covered this point earlier or not. Where we covered? While discussing the definition of plant, saying that plant excludes livestock. So livestock should not be considered as plant. On livestock you are not going to get any depreciation. Why you are not going to get any depreciation? Because the difference between the cost price and the selling price of a livestock is allowed to be as deduction in section 36 subsection 1 clause number 6. Section 36 subsection 1 clause number 6, you get deduction for loss on sale of livestock. So livestock will not be considered as plant, depreciation will not be allowed to you, but in the year in which livestock is sold or livestock is he died, we have sold his dead body, na carcasses. Whatever money is realized is the selling price. Difference between the selling price and the cost price will be allowed to you as deduction in section 36 subsection 1 clause 6. This point is not covered. Listen to me. In this point, the words written inside the bracket, they are generally not explained at the intermediate level. It is covered at final level. Do you want to understand? Shall I make an attempt? First of all, let us try to read and understand what it says. If an SSC acquires an animal for his business profession and such animal dies or becomes permanently useless, then the loss suffered by the SSC. What is the loss? Difference between the cost price and the selling price. This loss suffered by the SSC will be allowed as deduction. But this provision is applicable when the livestock is held otherwise than a stock in trade. So the loss difference between the selling price and cost of price of an animal is allowed to as deduction, provided that animal is held by you otherwise than a stock in trade. See, when we say otherwise than a stock in trade means you are holding it as asset. You are holding it as asset. So if you are holding it as asset, then difference between the cost price and the selling price will be allowed to as deduction while computing your business income in the year of sale of that livestock, in the year in which the livestock has died. But the point is, what if I hold the animal or cattle as a stock in trade? Then this section is not giving me deduction. Question is, why it is not giving me deduction? First of all, have you understood the question? Or let me, livestock, I can hold the livestock either as asset in my business, or I can hold this livestock as stock in trade in my business. If I am holding the livestock as asset in my business, then section 36 then by way of stock in trade. So if you are holding a stock in trade, why they are not allowing you deduction? Have you understood the question? So what? So what? Why not? Hey, let him. No, correct. Extend your explanation. So what? Why can't? If you are doing a business of furniture, if you purchase the bench at 2,000 rupees and you sold it for 1,800, there is a loss. Correct. So point is, if something is held as stock in trade for you, something is held as stock in trade by you, if there is a loss, it gets automatically adjusted in your profit and loss account. That is the reason we are not giving you deduction separately. If we give you deduction separately, then that would amount to double deduction. Anyway, loss is automatically adjusted in the profit and loss account. It is anyway adjusted in profit and loss account, means automatically you are getting the deduction. If we give deduction separately in section 36 subsection 1 clause 6, that would amount to double deduction. Let me take an example. This is the profit and loss account. For example, you purchased 5 buffaloes. Now buffalo is a stock in trade for you, so you will write 2 purchases. One buffalo is purchased at say 1 lakh rupees. So 1 lakh multiplied by 5 buffalo, 2 purchases, 5 lakhs. Now out of 5 buffaloes, you have sold 3 buffaloes at 2 lakhs each. 3 buffaloes you have sold at 2 lakhs each. So we will write what? By sales. 2 lakhs into 3 buffalo, 6 lakhs. 1 buffalo died and you sold so 1 more buffalo will be lying as a closing stock. So by closing stock, 1 lakh will be valued at cost price. So 1 lakh into 1 buffalo, that is 1 lakh. Now if you take the total credit side, it is 7.1 lakh. Same you take on the debit side, 7.1 lakh. What is your net profit? 2.1 lakh, that is 2 lakh 10,000. Now my point is, you acquired 3 buffaloes at 1 lakh rupees each. Those 3 buffaloes were sold at 2 lakhs each. So your actual profit is how much? Listen to it. 1 buffalo you acquired at 1 lakh, So 3 buffalo you acquired for 3 lakhs. Those 3 buffalo you sold for 6 lakhs. So what is your profit? Then why 2.1 lakh is appearing here? Because the 4th buffalo was purchased at 1 lakh. Dead body was sold at 10,000. There was a loss. That loss of 90,000 is automatically adjusted against the profit of 3 lakhs. That is the reason you are getting a net profit of 2.1 lakh. Now, listen to me carefully. The PGBP income starting point of solution will be 2.1 lakhs. Then, if you say that, give me deduction for the loss which I have incurred on the death of buffalo, 90,000 you give me deduction. If I give you deduction for 90,000, it will amount to double deduction because already 90,000 is deducted, Are you understanding? So if the livestock is held as stock in trade, the difference between the purchase price and the sale price will not be allowed as deduction separately, because it is automatically adjusted in the net profit. But if that livestock is held as asset, then the difference between the purchase price and sale price will be allowed to as deduction in the year of sale of livestock. Is that very clear? So I have made an attempt. I do not know whether it is a successful attempt or not. I have made an attempt to make you understand what is the importance of this word, otherwise than by way of stock in trade. Where I did I kept my mobile phone here? No, see here. Pick up. No. Hey, give me some phone or keep it on silent mode. I just want to see the timing. After each time will be there, huh? Watch. I have a target, na. Every section should be completed in some time, na. I can't devote 20 minutes time to a very small section. So I have a tendency to, what time it is? 8:16. No, 12:57. Okay. Anyway, so now we are going to discuss 3 sections. How many sections? 3 sections. First one is section 36 subsection 1 clause 7. Section 36 subsection 1 clause 7 along with section 36 subsection 2 along with section 41 subsection 4. So 36 1 clause 7 with section 36 2 with section 41 subsection 4. The concept is bad debts. What is bad debts? Debt which could not be recovered and it has become irrecoverable. It has become irrecoverable. So it is a loss for you or gain for you? Loss for you. So definitely you would like to claim deduction. So now in the chapter of PGBP, the section which is giving you deduction for bad debts is section 36 subsection 1 clause number 7. Section 36 subsection 1 clause 7 says, listen to me carefully. Section 36 subsection 1 clause 7 says deduction for bad debts will be allowed provided 4 conditions which are given in section 36 subsection 2 are fulfilled. Which section is allowing you deduction? Section 36 subsection 1 clause 7. But it says you have to fulfill the conditions which are given in section 36 subsection 2. Clear? Now, for example, whatever income I am earning by taking the lectures is a income from profession for me, na? Income from profession. So my income is also taxable under the head PGBP. Now say for example, our lectures will be conducted up to 10th of May. So 8th May, just 2-3 days before completion of the syllabus, Manoj came to me saying that, sir, should I ask you, actually I am in double mind whether I should ask you or not. I told him, don't worry about it, whatever you want to ask, you ask. So he says, sir, actually I wanted 5,000 rupees. That is what he. So I told him, why you need it? Sir, actually I took from someone. I took 5,000 from someone saying that I'll pay you after 6 months. At that point of time, he gave me 5,000 rupees, but now he's asking me very urgently. He says that by evening you pay me 5,000 rupees. So I took his bank account and I transferred 5,000 rupees to him. Do you believe it is my business transaction? No. So Manoj told me that, sir, I'll repay that 5,000 back to you after 1 month. After 1 month, I went to Mumbai. I used to call frequently to Manoj, but he has changed his mobile number. SIM card is changed. So now it is nearly confirmed for me that this amount has become irrecoverable. So I have passed an entry in my books of accounts, bad debts account debit. Can I claim deduction for this? Bad debts, can I claim deduction? Why? Because it is not a transaction connected to my business or profession. Section 36 subsection 1 says deduction for bad debts will be allowed provided the debt was incidental to your business. Debt should be incidental to your business. If the debt is not incidental to your business, we are not going to give you any deduction. Is that very, very clear? Another example. First condition, have you understood now? Debt should be incidental to business. If the personal debt turns out to be irrecoverable, you can't claim deduction for the expense. You can't claim deduction for that loss, considering it as bad debts, because your debt is not incidental to your business. Now, say for example, I am having a grocery shop, retail shop. I am purchasing goods from a wholesaler and I would sell it to customer. So there is a wholesale market of food grains. So as a retailer, I would go to the wholesale market and I would buy in more quantity and I sell it to customer in small packs of 5 kgs, 2 kgs, etc. So when I went to purchase some goods for me in the wholesale market, when I was going through that lane, in one of the shop, I saw that Manoj is sitting over there. So I went there and I asked him, Manoj, what you are doing here? So he said, sir, you are in my shop only and you are asking me what you are doing here? So Manoj says, sir, I completed my CA intermediate. Thereafter, I did not do CA final. And because of some personal reasons, I left the CA and now I am into wholesale business. So I told Manoj that, oh, you are into wholesale business. So I am also having a retail shop. I am taking lectures also and I am having a business of grocery also. So retail shop, I have appointed an employee, he is running the business. So I will purchase grocery in wholesale from you. That is what I told him. So he says, no, sir. I don't sell it to small retailers. I am having a very big export business. So I am not, if you want to purchase a wheat, you will say that give me 5 sacks of wheat, 30 kg one bag, 5 bags 150 kg. We don't sell this much low quantity. We sell it in bulk, 1 truck, 2 truck, 3 trucks, etc. So I will not be in a position to deal with you. He says, I will not deal with you. And he says, in past, in my business in past also, my past experience is, I have dealt with lot of retailers, they don't pay money on time. And sometime your money becomes irrecoverable. So small retailers, we don't trade with them. So I told Manoj, no. See, everyone is not a bad person. So if I purchase good from you, it is not necessary that your money will become irrecoverable. I will pay you in advance. So Manoj says, oh, you pay me in advance. So do one thing, I will deal with you provided I don't want to take risk. Because if you take goods on credit basis and if you don't pay, I will be losing the funds now. So I don't want to take the risk. Do one thing, you keep a deposit of 2 lakh with me. You keep a deposit of 2 lakh with me. Then I'll do a transaction with you. And if at all you don't pay me money, I'll adjust against the deposit. So I told him, how much deposit you need? He says, only 2 lakh rupees. I told him, I'll transfer in 2 minutes time. On the spot, IMPS payment done. 2 lakhs credited to his account. His ego is satisfied. So I paid him 2 lakh rupees. Now I would not visit the wholesale market. I would just pick up the phone and I'll talk with, call him, and I'll say that this much amount of goods you send it to me, and I'll make payment in 30 days. 3-4 months everything was fine. One fine day when I tried to call up Manoj, he was not picking up the call. Generally he don't pick up the call on the first ring only. I need to call him whenever I need to call him, I call him at least 3-4 times. But this time I'm calling his last 3-4 days. He has not picked up the call. So finally I went to that wholesale market, and when I went there, I saw that his shop is closed. The next shop, I asked him, there was one person, Manoj, doing business, wholesale business, where he went? He says, no, he has taken money of all the suppliers and he has ran away. The shop was on rent. So that person says me, how much money you have lost? I told, no, I have not lost anything. But he has taken away my deposit of 2 lakh rupees. I gave him a deposit, 2 lakhs. He took away that deposit and ran away. So when I gave deposit to him, what entry I would have passed in my books? He is my supplier, I would have passed some entry in my books when I had given him deposit, So I might have passed the entry deposit with supplier. Deposit with supplier account debit to bank account. 2 lakhs. Now this deposit would appear where in my financials? Will it be debited to profit and loss account? No, it will appear as an asset in my balance sheet. So this is appearing as an asset in my balance sheet. This is the first entry which I had passed in my books of accounts. Now Manoj has ran away. So my 2 lakhs, now they have become irrecoverable. So I have passed an entry in my books, bad debts account debit to deposit with supplier account. Bad debts account debit to deposit with supplier account. And then finally I have passed an entry, profit and loss account debit to bad debts account. Profit and loss account debit to bad debts account. My question to you is, can I claim deduction for this loss in section 36 subsection 1 clause 7? Have you understood the question? This deposit with supplier has turned out to be a loss. So I passed entry, bad debts account debit to deposit with supplier and P&L account debit to bad debts. Can I claim deduction for these bad debts? Can I claim deduction for these bad debts in section 36 subsection 1 clause 7? Answer is no. No. Why na? Second condition, you read the second condition, it says what? That debt should have been taken into account in computing the income of the SSE. Means when the debt was created, when the debt was created, that debt should have been taken into account while computing my income in the year in which the debt was created. So one effect should go to income. Then only in future, if that turns out to be bad debts, will give you deduction. I passed the entry. What entry I did pass? Deposit with supplier account debit to bank account. Do you believe that any of the effect is going to my profit and loss account? Any of the effect is going to my income? No. So if this debtor turns out to be a bad debt, then you can't get deduction in section 36 subsection 1 clause 7. Because second condition says such debt should have been taken into account while computing the income of the SSE in the past years. Have you understood? See, for understanding the second condition in a better manner, Listen to me carefully. I am dividing the business into two. Number one, non-banking business. Which business? Non-banking business. I had a transaction with Manoj that who neither I am into the banking business nor he is into the banking business. So for a non-banking business, second condition says such debt should have been taken into account while computing income of the SSE. By passing this entry, I had not taken any debt in my income. So if I write off this debt, no deduction in section 37 subsection 1. When the debt is created, it should have been taken into income. Then only deduction for bad debts will be allowed. In other words, indirectly what they are trying to tell you? Indirectly they are trying to tell you that we will allow you deduction for the bad debts provided the first entry was debtors account debit to sales account. Because when you pass an entry debtors account debit to sales account, the second effect goes to income. Are you understanding? Oh, yes or no? When you pass an entry, when you sell the goods to your customer on credit basis, you pass an entry debtor account debit to sale account, and that sales account will get reflected in the profit loss account credit side, means one effect has gone to income. If this debt in future it turns out to be a bad debt, then I can claim deduction. Because condition 2 says one effect should have been gone into income in the past. So when I pass an entry debtor account debit to sale account, one effect has gone to income. But if I pass an entry deposit with supplier to bank, one effect has not gone to income. But still, after so much amount of explanation, still you might not be convinced. You will feel that no, this should also be allowed as deduction, no? Because this is also related to my business only. So I want to tell you that there is no separate section for allowing you deduction for this bad debts. Can you still claim deduction? Can you recollect any section wherein you can claim deduction? No, no. Have you revised PGBP chapter? Are you revising on a daily basis? Yesterday only we referred to section 28 charging section. Section 28 clause number 1 first point says what? What is chargeable to tax under that PGBP as per section 28 clause 1? Profits and gains of any business or profession carried on by the SSE during the previous year. How do you compute that profits and gains? Revenue incomes and gains minus revenue expenses and losses. Now we will realize the importance of those things. Revenue incomes and gains minus revenue expenses and losses. Listen to me carefully. Don't you feel this deposit with supplier 2 lakhs is also related to my business? If the supplier has ran away taking away that deposit, it is my revenue loss. It is my revenue loss. It is not a estimated loss. It is not a fictitious loss. It is actual loss. It is a real loss. That loss is actually incurred. So can I claim deduction? Answer is yes, I can claim deduction. Where? In section 28 clause 1. So if this turns out to be bad debts, I can claim deduction in section 28 clause 1, but not in section 36 subsection 1 clause 7. Because section 36 subsection 1 clause 7, second condition says that one effect should have gone to income. Have you understood this? The last part of second condition. If SSC is into banking business, if you are into banking business means you will give loan to others, na? What entry will pass when you give loan to customers? See, for a bank, the borrower is a customer. For bank, borrower is a customer. So when the bank is giving loan to the customer, what entry they would pass in their own books of accounts? Customers loan account debit to bank account. Correct? Huh? If you pass this entry, do you believe that one effect has gone to income? In this entry, do you believe that one effect has gone to income? In case of banking business, one effect can never go to income, because the two accounts which are involved, both are balance sheet accounts. Therefore, that condition number two, listen to me, that condition number 2 is bifurcated in two parts. For banking business, separate condition. For non-banking business, separate condition. For non-banking business, what is the condition? That debt should have been taken into account while computing income of the SSC in the past. For banking business, the condition is that debt should represent money lent in the ordinary course of money lending or banking business. Do you believe that this entry represents a debt? It represents a money lent in the ordinary course of money lending business? Yes. Have you understood the second condition? Yes or no? See, read this. It should have been taken into account in computing the income of the SSC. This sentence is for which business? Oi. This sentence is for which business? Non-banking business. Or it should represent money lent in the ordinary course of banking or money lending business. Is that very clear? Have you understood the second condition? Okay. Now, for example, I am having a grocery business. Manoj is my customer. I have sold some goods to him on a credit basis. So I would have passed an entry in my books of accounts, debtors account debit to sales account. So can I say one effect is gone to income and this is my business transaction. Now, I had sold the goods to Manoj on a credit basis. I had given him a credit period of 30 days. 30 days are over. So I called up Manoj, that's saying that please make the payment, 30 days are over. So he says, sir, this time because of COVID, I have not yet got my salary. So wait for 5-10 days. I waited for 5-10 days more. Once again I called him. Once again he is giving the same answer. Then after a few days, once again I called him. He says that, sir, I have lost my job. So he is not saying no, that I will not make the payment. But every time he is having some reason ready with him. Saying, sir, because of this I can't pay. Because of this I can't pay. Instead of 1 month, 6 months are over. Now I feel that this amount I may not recover. I am not confirmed, but I feel that this amount I may not recover. So it is not bad debts for me. It is RDD for me. Doubtful debt. So what entry I will pass in my books of account? Profit and loss account debit to reserve for doubtful debts account. And this reserve for doubtful debts account will be deducted from my debtors in the balance sheet asset side. And my profit and loss account debit side, it will appear as 2 RDD. So I have debited my profit and loss account with RDD because I am doubtful whether I will recover this money or not. Now my question to you is, can I claim deduction for this? No. Why? Because the third condition in section 36 subsection 2 says deduction will be allowed only if the debt is actually written off in the books of accounts. If you pass an entry profit and loss account debit to RDD account, do you believe that the debtors account will get affected? No, not at all. When the debtors account will have a effect? When you pass an entry bad debts account debit to debtors. So government basically tries to tell you that your first entry should be debtors to sales, second entry should be bad debts to debtors, then only you will get deduction for bad debts. When you pass an entry for RDD, it is just a provision you are creating for the future loss. It is not an actual loss, it is a probable loss, it is a estimated loss, it is not a real loss. So government says this estimated loss, fictitious loss, we are not going to give you as deduction. So moral of the story, one line conclusion is any provision is not allowed as deduction. It should be an actual expense. Only then it is allowed as deduction. Provision cannot be claimed as deduction. That was which condition? Condition number 3. Now, for example, Manoj, I sold goods worth 2 lakhs to Manoj on a credit basis. Now, I am asking him for money since last 6 to 8 months. And finally, I called up now once he was in office. So, he has not paid me since last 7-8 months. I am fed up calling him again and again. He did not pick up the call. He has changed his number. Somehow I came to know his new number. So I called him and he picked up the call. And I said him, Manoj, I am calling you since last 5-6 months. You have changed the number. You don't have the courtesy to call back to me and say that, sir, I'll pay that outstanding amount in that this much amount of time. So he says that, sir, I am in office. How can you call me when I am in office? And now you will speak to me for 15-20 minutes. You will give me long lectures. So why you are wasting my time in office? See, he has not paid me since last 8 months. Now I should be shouting at him. Instead, the situation is reversed. He is shouting at me. And the moment I started shouting at him, he said that I will not pay you even 1 rupee. Do whatever you want to do. So now it is confirmed that this amount has become irrecoverable. I am very soft-hearted person. So when I came to know, weak by heart. So when I came to know that my 2 lakh rupees has become irrecoverable, no? The moment I kept the phone, I got a heart attack. Gone. So I had passed one entry in my books of account, debtors account debit to sales. Now that debtors has turned out to be bad debts. Before I pass an entry, government has given me exit out of this world. So after my death, my business is taken over by my child. So by way of inheritance, he has got the business. And now he has passed the entry for bad debts. He is passing an entry, bad debts account debit to Manoj's account, bad debts account debit to debtors account. Can he claim deduction? Debtors to sales entry was passed by me now. He is passing entry, bad debts to debtors. Can he claim deduction? Because he is a separate SSE. I am a separate SSE. My income tax return is different. His income tax return is different. Can he claim deduction? So in one of the important point, in the proviso, government has said that successor can also claim deduction in respect of debt which was created by the predecessor. Successor can claim deduction in respect of debt which is created by the predecessor. Decision, there are few decisions in the court which are given based on this. So even a successor can claim deduction in respect of bad debts for which the debt was created by the predecessor. With logic which is given by the courts now for giving this decision, court said that SSE has changed. And that is correct, SSE has changed, but the business has remained the same. The same business debt was created, same business the debt is written off in the books of account. So even though SSE has changed, bad debts deduction should be allowed. Have you understood this? Now, I was having which business? Grocery business. There are a lot of people like Manoj in my life to whom I have sold goods on credit basis and now they are not paying me money. So, I went to Pujari Maharaj, he would see your Kundali. Astrology, yes. So I took my date of birth, time of birth, etc. I went to an astrologer And he says that if you do this business throughout your life, na grocery business throughout your life, if you do according to your date of birth, time of birth, etc. If you do this grocery business, there will be a time in your life when you will not have even a grocery to eat at your home. So you will incur losses year after year. Do one thing according to your date of birth, time of birth, etc. For you now, clothing business will be more beneficial. So you stop this business immediately. So I took his consultancy. I decided to follow whatever he said to me. Immediately I stopped my grocery business. Everything is sold at 25% discount and my shop is entirely empty. I made new furniture, new layout, and I started clothing business. I had sold grocery worth 2 lakh to Manoj on a credit basis. He did not pay me. Now I am asking for money from him. So he said, sir, already you have stopped grocery business. Now why you are asking money? Huh? Should give me na. See, I had sold grocery to him at credit basis. So, despite me stopping that business, he should pay me money. He has not paid me money. So what should I do? I should pass an entry for bad debts and claim deduction. So I have passed an entry, bad debts account debit to debtors account, P&L account debit to bad debts account. Can I claim deduction for that bad debts? Government says, no, we will not allow deduction. Why? Because government says in one of the condition number 4, government says, if you want deduction for bad debts, na, the business in respect of which you have incurred bad debts loss, na, that business should be continued. If you stop the business, we are not going to give you a deduction for bad debts. Have you understood that? So we have discussed how many conditions? 4 conditions and 1 proviso. Point number 1. What is that? Point 1. Oi, what is point 1? That should be incidental to business. Point 2. If it is non-banking business, that debt should have been taken into account while computing the income of the SSE. If it is a banking business, that debt should represent money lent in the ordinary course of money lending or banking business. Number 3, debt should be actually written off in the books of account. Number 4, the business in respect of which bad debts is incurred should be continued during the previous year. Important point to be noted, deduction is allowed even to the successor of business. So if I die, my child can pass an entry for bad debts and he can claim deduction. It is not necessary to prove that debt has become bad. In this case, Southern Technologies Limited versus CIT, Supreme Court judgment, TRF Limited, Supreme Court judgment. You need not remember this case law. These are discussed at CA final level. In this case law, Supreme Court has said that it is not necessary for me to prove that debtors has become bad. See, if the income tax officer asks me to prove, now how do I prove? I'll ask Manoj to come in front of income tax officer and say that no, I will not pay money. So if I ask him to come in front of income tax officer, even he was about to pay me, he will not pay me, na. He will say that because of you, my image has become bad, na. So government says, Supreme Court has given the decision saying that it is not necessary for the business organization to prove that his debtors has become bad. So without proving only, you will get deduction. In other words, even if I feel that debtors is good, I pass the entry for bad debts, can I claim deduction for bad debts? Yes, because there is no need to prove. Have you understood this? So how many conditions? 4 conditions we have discussed, 2 important points we have discussed, and when we meet tomorrow, we'll complete this point number C, important point.